A Bitcoin ETF, a CPI report, and an EV about face over at Hertz. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. You take a look at stocks right now, looks pretty soggy, though. We are off our session lows. You take a look at the S&P 500, down about 0.2%. We were much lower earlier in the day, about 0.9%. So coming back here, you can see the NASDAQ 100 just flipping green right now, currently unchanged when it comes to big tech. We'll see how that settles up. You take a look at the bond market, a lot of volatility, of course, in the 10-year yield after that CPI print. Of course, CPI print coming back up a little bit. Take a look at yields currently off by about 1-2 basis points. And Bitcoin's big day. We finally got those spot Bitcoin ETFs. A lot of volatility too. If you take a look at the cryptosphere, though, Bitcoin currently up about 1.4%, Romaine.
Yeah, providing a little bit of a lift here for Bitcoin. Some of the individual stocks are lower, but this is that moment in the sun after the approval of those 11 ETFs, and that's now being punctuated by stablecoin provider Circle's draft registration for an IPO. A registration that comes more than a year after Circle scrapped that bid to list via a SPAC deal. Now, we should point out that that confidential filing is more than a coincidence. The scuttlebutt for months has been that a spot Bitcoin ETF approval would bolster other pockets of the crypto sphere. Owen Lau, an analyst over at Oppenheimer, telling Bloomberg Circle's IPO proposal, at a minimum, opens the door for a conversation with the SEC to figure out who should regulate stablecoins and how. Hopefully that won't take as long as Bitcoin. And while the crypto industry pops champagne and prepares for a somewhat brighter future, the future of another industry, EVs, looking slightly dimmer than a few months ago. Unit sales growth at EV makers have slowed significantly, and now we're learning Hertz, which made a big to-do a couple years ago about adding 100,000 Tesla vehicles to its fleet, is now planning to sell off a third of its U.S. electric vehicles and reinvest in gas-powered cars. Hertz said customer demand for renting EVs hasn't been enough, and high repair costs on those EVs has been a bit too much. No idea how this affects Tom Brady. We'll get back to that Hertz story and to the Bitcoin story in short order. But we do start off the show with a look at the U.S. economy and the latest U.S. inflation report. A report, Katie Greifeld, that showed a reacceleration in consumer prices for housing, electricity, as well as used cars.
Indeed, if you take a look at the chart behind me, you can see that tick up. If you take a look at that pink line, I know it's hard to see, but 3.4%. That is the reading on year-over-year headline inflation figures. So a reacceleration, maybe not what the Fed wanted. You can see in those bars in yellow there at the bottom that energy continues to maybe help what we're seeing. But of course, you did see that acceleration back to 3.4%. What's interesting, though, if you take a look at what this means for the markets thinking around the Fed, apparently not too much. Of course, the market would tell you that a March Fed cut is still more likely than not. That pricing didn't change too much on the heels of this inflation report, Romaine. It's going to be interesting to see if that pricing changes.
All right, let's get some insights out of our first guest, Tiffany Wildey, joining us right now, economist over at PIMCO, helping us kick things off to the close here. And on the heels of that outlook for the 2024, basically over the next 6 to 12 months here, did anything actually change in your mind after seeing the CPI report this morning?
Yeah, I mean, not really. I mean, I thought this report was pretty much in line with expectations. In the sense that the broad themes that we've been highlighting, I think were very much underscored in this report. Those broad themes include the disinflation that we saw in 2023, which was historically notable for how much disinflation we got. That was largely the result of, supply chain normalization, energy shocks, which were fading, things of that nature. Just some normalization in things after the pandemic and those related disruptions. And that resulted in a very quick disinflation. But nevertheless, additional disinflation from here probably will be, much slower, a little bit more nuanced, and definitely will also rely on the labor market cooling a little bit. And I think this, this report sort of underscored those themes. We're not going to get the tailwinds from supply chain normalization forever. You can't go to heaven twice, as they say. And obviously, this will complicate the message for the Fed.
Well, and does that complicate, I guess, the strategy, the investment strategy for investors out there who, of course, had been betting on a pretty persistent bond rally this year?
Yeah, well, when we look at, the front end of the interest rate curve, the Fed funds futures strip, basically what we see is that the markets are currently already pricing a cutting cycle that is historically very consistent with other soft landing cutting cycles that we've seen. And so for the market, the bond market at least, kind of to price in more cuts from here, we've argued that you need to actually see, data that's confirming that recession risks should be more elevated. And the other thing that we've just been highlighting is that, that can certainly happen, but there's also a fat tail on the other side of the distribution here. It's possible that you could see some reacceleration in inflation, and the markets, seem to be, discounting that kind of, risk as well. So, I think the risk to the bond market here is more asymmetrical, but nevertheless, the other thing I would just highlight is that neither of those scenarios are particularly good for risky assets. And I think that's kind of some of the things that we're seeing in the broader price action for equities right now.
Well, that's what I wanted to ask. If the risks are asymmetric in the bond market, but then you take a look at risk assets, and it sounds like the bond market is still the place to be, especially when you think about where yields are.
Yeah, I mean, if you kind of look, just take a broader step back, so zone out. What we've been talking about is kind of more near-term tactical trading, and valuations in the very front end of the curve. But if you look further out, the intermediate sector, when we look at, intermediate real rates, for example, they're still elevated relative to what we think is kind of that new neutral range. We see the five-year real rate, for example, of, kind of 175 or whatever, whatever it's trading at today. It's elevated versus the 0 to 1% new neutral range that we've highlighted. So there's definitely, the Federal Reserve is restrictive. There's definitely still some value there that we see. But again, this is, if you look out further to credit, high quality credit as well as securitized products, there's even more value. So there's definitely still more value in the bond market, even though there's probably some tactical trading opportunities as well in the front end.
I also want to talk a little bit more about what's priced in. Of course, you mentioned that you take a look at markets and they're pricing in pretty significant rate cuts when it comes to the Fed. The first coming in March. You think about what we learned this morning about inflation in this economy. Does March seem realistic?
Well, I think the one of the benchmarks here that we're looking at, is that just optically, we think core PCE inflation needs to be running below 3%, for the Fed to feel more comfortable starting to cut rates. And it's going to be pretty close. We still think it will be running a little bit above that, maybe more in line. So our expectation has been that it's probably more reasonable for the Fed to start cutting, more closer towards the middle of this year. March is maybe a little bit too aggressive. But, nevertheless, there's some data between now and then. Obviously, it's certainly possible. I think Fed Chair Powell put it in play. It's a live meeting, if you will. But nevertheless, we're just not convinced that the inflation data is going to fully cooperate with that.
Tiffany, always great to catch up with you. Tiffany Wilding, PIMCO's economist, helping kick things off to the close here on this Thursday afternoon. Coming up here, we're going to talk about the first day of trading of those spot Bitcoin ETFs. A slew of guests to talk about it, including former CFTC chairman Tim Massett, as well as Steve Kurtz over at Galaxy Asset Management and Brian Hardigan over at Invesco. Those last two companies have partnered on the spot Bitcoin ETF, BTCO.
Plus, Hertz plans to sell a third of its U.S. electric vehicle fleet. We'll look at why they're shifting back to gas-powered cars. And a focus on Africa. Boris Kodjoe, the actor and entrepreneur, is now the co-founder of the Full Circle Africa Economic Conference. We're going to talk about what his aim is and where the investment opportunities are. That conversation and so much more coming up in a bit on The Close. This is Bloomberg. Well, it's the first day of trading in the U.S. for spot Bitcoin ETFs following the SEC's approval after the close yesterday. Now, that decision is seen as a landmark event for the roughly $1.7 trillion digital asset sector. Joining us now is Brian Hardigan. He is global head of ETF investments over at Invesco, and Steve Kurz, global head of Galaxy Asset Management. Now, these two firms have teamed up for their spot Bitcoin ETF offering. The Invesco Galaxy Bitcoin ETF, ticker there is BTCO. BTCO. And Brian, that's where I want to start because both Invesco and Galaxy totally capable of standing on your own here. Why did these two firms decide to partner together for this?
Sure. Thanks for having me, Katie. This is really an extension for us within the product suite in alternatives that we've managed for many, many years. Obviously, we run a multi-billion-dollar platform within the ETF space. We have multi-asset capabilities, and we really wanted to expand not only our delivery mechanism, but our partnership with a partner that really knows the digital space. And that's where Galaxy comes into the fold for us. So really bringing those two together for us delivers a great opportunity for investors to access this market via the ETF.
Well, Steve, let's talk more about the digital asset space. When you think about the fact that you have 11 ETFs coming out of the gate all at once today, is there enough demand to support all 11?
Yeah, it's a great question. And look, it's a great day for investors because there are 11 products, and it's a great day for Bitcoin. We've been doing this in 3 different jurisdictions with Invesco, and this is more of the same for us. I think the labor of love is going to be not just the first day or the first week, but really the next 12 to 24 months of real on-the-ground education. We all feel like we've run a marathon to get to the starting line, but it really is just the starting line. And so the demand is going to come from the contextualizing of Bitcoin in a portfolio, the sizing of Bitcoin in a portfolio, having those conversations with our partner Invesco in the institutional wealth space, and just doing that over and over again and introducing people to a really transformative and interesting asset in Bitcoin.
In the lead up to this, in the lead up to this, Steve, did you actually see an increase in activity by clients or potential clients asking for more information about it?
Oh, absolutely. I mean, look, we've had 6 years of doing this at Galaxy. We've got a $5 billion AUM asset manager. We've had thousands of meetings. The last 6 months have been night and day to the first 6 months of last year. I think this is really a watershed moment, not for the obvious reasons, but because at that ground level, hand-to-hand combat, there was finally a door that's open and a real conversation to be had about how is this a tool in the portfolio as opposed to just a headline or a volatile asset.
Well, that's going to have to be a big conversation, Brian, particularly when it comes to the advisors that are going to be pushing these ETFs, pushing them presumably to a group of people that aren't maybe as necessarily well versed in the ins and outs of how the crypto sphere works here. What do you anticipate being sort of the number one question that people will have?
That's absolutely right, and that's our plan. You know, we've built multi-asset, complex portfolios from bank loans to commodities, and we've spent the better part of our history educating and working with our advisors and client base as to how to allocate. And I think that's going to be the long game here in terms of how do clients use digital currencies, digital assets into their portfolios. And that's where the education and the engagement with clients and advisors is really going to help set folks apart in this race, if you call it, because that's where a lot of the questions are from clients. When do I allocate? How do I allocate? Now that it's open within the ETF structure, that really generates the opportunity for clients to get that ease of access.
Brian, I want to talk a little bit about fees here because the fee war that we've seen so far has been pretty astounding. You take a look at the fee on your product that you're offering, 39 basis points, the eventual fee. You do have a fee waiver in place for 6 months where you will charge nothing. Of course, you had actually lowered that fee before it even launched because the fees here are so low. Is there a break-even level of assets that your ETF needs to accumulate for it to become profitable?
Sure, great question, and quite a bit of focus on fees. But we really, as I said at the outset, this is an extension of our product line. We've been in the alternatives and commodity space, so we look at it holistically as to how might advisors and clients utilize digital assets as part of their portfolio allocation tools. So we don't look at it on an individual basis. We also do focus on the total cost of ownership. What are the total fees in terms of spreads and performance? And with this being day one, as we enter the markets, I think that's where you're going to be able to see some of the differentiation in terms of long-term performance. And we're really confident with our partnership that we'll be able to set ourselves apart in terms of total cost of ownership.
Well, Steve, let's talk a little bit about the long term here because, as I mentioned, there's 11 of these ETFs coming out of the gate. No first mover advantage here. You all own the same thing. When you look out over the long term to, say, a year or so from now, what would success look like for this product from your view?
Yeah, look, I just want to be clear. There are 11, but that doesn't mean that these are all the same. I think that we talked about the ground game, but I want to put a finer point on the tracking error. We manage a cash create ETF in Canada as Galaxy, and just in 2023, we tracked 1,000 basis points, so 10% better than our biggest competitor. So what's the point of talking about a few basis points of fees when you're talking about how you manage the liquidity of a very volatile underlying asset? So success in the long run, to answer your question directly for BTCO, we're going to have great liquidity around the products. We're going to have options and an overall ecosystem that allows us to track very well, to have great liquidity for the products, and then to educate investors about what to do with that product. And then the product will scale and the results will take care of themselves if we do that.
All right, guys. Well, congratulations to you. Obviously, you have a lot of work ahead of you. Our thanks there to Brian Hartigan, Global Head of ETFs Investments over at Invesco, and Steve Kurtz, Global Head of Galaxy Asset Management. We'll be covering this story all day long. But in the meantime, we are going to pivot after the break to a big story here in the world of finance here. The leader of CalSTRS, the second largest U.S. public pension fund, their CIO for the last 20 plus years, stepping down. We'll have the latest after the break. This is Bloomberg.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
A leadership change at the second largest U.S. public pension fund. Chris Ailman, who's been the CIO over at CalSTRS, announcing today that he is stepping down after almost 25 years of directing investments there, the retirement plans for that state's teachers. I had a chance to actually sit down with him to talk about his career move, his investment strategies, and what the next challenges will be for the next CIO.
It's time for a transition for me, for CalSTRS. I've been, as you said, public fund CIO for 38 years, but I'm ready to retire. I'm ready to slow down.
Have they found a new CIO?
No, they'll launch a public search here in the springtime. It's a civil servant job, so it's open. Anybody can compete, and they'll have a full search committee. This is well planned out. I've been talking to the investment committee for a couple of years about succession planning, so For us, this is a plan that we'll execute and make it pretty smooth. Because you're right, it's been a change. It's the first time a change in a long time.
And will you be involved at all in that search process?
No, because it's public service. I've just I write the exam and help advise, but no, I stay outside and I'll just watch the process.
You've been there since 2000, and in that time, you've done quite a bit, not just in terms of just managing money or overseeing that money, but really in terms of tweaking the strategy, not only of what CalSTRS does, but of course a lot of your peers ended up following suit. I do want to go through some of those strategies that you've adopted, and let's first start off with that push into private equity and private debt, something that at the time you pursued it was still relatively novel for a pension fund.
Yeah, you know, Romain, when I got to CalSTRS, it was a pretty sleepy, simple asset allocation and a really small team. And my goal was to make us a global asset manager. And you're right, I told the board at the time, I really thought they could put more into privates, private equity, private real estate. I think our allocation was about 3% to private equity. They had just hired a new head of the area who came from Canada. I came from the state of Washington, where private equity was a key part of the portfolio. And I really felt it could add value. So we set goals, grew that portfolio over time from, you know, something in the couple of billions all the way to where it is now. It's 16% of the fund and $45 billion. And private markets in general for us is now 45% of the portfolio. So a very significant change in the asset allocation.
It's effectively the second largest portion of the portfolio after public equities. Is that right?
That's correct. You've got public equity. Then we're now at 15% in private equity and in real estate.
What was the rationale between pushing those allocations higher and higher into the private side of investments? Was that specifically about a better return than what you can find in public equities?
You know, we're always return focused. It is always about return, but long-term return. So for us, what I really said to the board is, hey, if we're a long-term pension plan, which we were, one of the oldest, CalSTRS has been around since 1913. We should have a long-term horizon, and therefore we're making longer investments in things that are private, that have a long return and a better risk return profile. So both private equity and real estate really added a lot to that simple kind of 60-40 equity debt portfolio.
How much has, I guess, the investing landscape changed from the time you first entered into the business to the time that you started in CalSTRS 20 plus years ago here? I mean, what is the challenge now for, I guess, maybe your successor or really anybody coming into this space who has to manage a large amount of other people's money?
You know, Romain, I have to laugh when I look back and I started in the business in the late 80s. It really felt like it was complex back then, but man, is it complex now. Geopolitics dominate, and just, you know, it is a very diversified and globally complex portfolio. And I think really, number one, geopolitics, number two, climate change are mega trends that are really going to affect the world, the economy, and then obviously our returns.
Chris Ailman, the CIO of CalSTRS, is going to be stepping down at the end of June, and he'll stick with the company, or excuse me, I should say with the pension fund until the end of the year to help sort of guide the transition here. But he'd point out he's pretty much spent his entire career in public pensions. I think he started out at Dean Witter, but pivoted pretty quickly to running Washington State's pension fund and eventually California State Teachers Fund.
Yeah, it's a really impressive career, and it's definitely an end of an era when you think about how long he's been in the chair. What's interesting, though, is that you have CalSTRS and CalPERS both looking for a new CIO simultaneously. It was interesting to hear Chris say that anyone can apply, you know, when they start their search.
And I asked him, we didn't get a chance to play it, but I did ask him about how hard it is to find someone new. I mean, it's rare for folks to stay that long in this position. He talked about how his predecessor had only been there 3 years, and that when they were interviewing him for the job, it was really about how long are you going to stay. Now, he didn't think he was going to stay 23, 24 years, but here you are. And of course, you know, you can go to the private sector and probably make 3, 4, 5 times of what you could make running a public pension fund. But for him, this was a labor of love. Sister is a teacher. Another one of his relatives is a teacher as well. So it's very close to his heart.
Yeah, family business for sure. And some interesting moves. I mean, you think about what he did at CalSTRS, turning to private equity, private credit, really helped returns as well.
And he brought a lot of that management in-house instead of just farming it out, kind of the way the Canadian model used to do, and Greg Jensen and those folks. So interesting end of an era here. Stick with us. A lot more coming up here on the program. We'll be back in a moment. This is Bloomberg. This is the countdown to the close. Keeping an eye on the broader markets right now. Equities have been on the back foot for a good portion of the day, and that big bump that we were supposed to see in crypto, not quite materializing, but there is a lot of activity going on in commodities. Let's get right to Abigail Doolittle, who's standing by right now with our commodities close.
There certainly is, and this board is mixed, and we do, of course, have the Bloomberg Commodity Index higher, slightly higher off of its highs, having a lot to do with crude oil. Crude oil had been up much more before, now up about 0.8%. One piece of activity supporting crude's somewhat bullish action at this point is Iran seizing a tanker in the Gulf of Oman that could threaten key shipping lanes. Continued action there. Natural gas up 1.9%. Cold weather supporting natural gas. On the other hand, you have a lot of weakness for the metals and wheat. And making this really interesting, Romaine, the Bloomberg Dollar Index really not doing all that much. Typically, you would see the metals respond to a sharply higher Bloomberg Dollar Index, but today they seem to be responding to the downside even without that force. So overall, right now, commodities up ever so slightly.
All right, our thanks there to Abigail Doolittle. A look at what's been going on in the commodity space, and she mentioned some of the disruptions in some of the main shipping lanes around the globe. That wave of missile and drone strikes on ships in the Red Sea has really caused the biggest disruption to global trade since the pandemic. The latest numbers show container rates continuing to rise as Iran-backed Houthi militants step up their attacks, and oil prices are following that trend today. Pleased to say, joining us right now to talk a little bit more about this is Jason Fear, Global Head of Business Intelligence over at Potent & Partners, is one of the biggest brokers and advisors for LNG shippers. Thanks for joining us, Jason. And I do want to start off, before we get specific about everything that's going on in the Red Sea, I do want to start off with the latest news about this this vessel that was, I guess, apparently taken back by the Iranians from the U.S., which just seems to be adding just a lot of more agita right now to the market over just how safe it is right now to traverse these waters, whether you're going through the Red Sea or somewhere else.
Yeah, I mean, and I think that's probably the aim is just to continue to stir the pot, to push freight rates higher, to push oil prices higher, to sort of cause, I guess, discomfort among supporters of Israel. And so I think that's really the goal here is just to sort of keep markets on edge. I think basically, the U.S. has been working. We were going to talk later about what's happening in the Red Sea. But obviously, I think it's in Iran's interest, especially with the recent softness in oil prices, to try to keep markets tight and on edge. And I think obviously this seizure of this tanker does that.
Obviously, what's going on today, what's going on in the Red Sea, some of the climate issues affecting the Panama Canal. We've been looking so much at these shipping rates and that uptick, and we should just put the asterisk next to this that we're nowhere near some of the pandemic levels that we saw on those shipping rates, but they are significantly elevated. And I am wondering if you expect them to continue to go higher.
You know, I think one of the things we've seen, I think, in a lot of the segments in oil tankers and in LNG carriers, a couple of things. One is there's just sort of abundant supply and fairly soft demand, particularly in China. So oil demand has been soft. LNG demand has been soft. And that's basically, I think, taken what otherwise would be the sort of edge off of prices. So you haven't seen either freight rates rising, because I think there's plenty of vessels around. But also just demand is fairly sluggish. And so I think that's helped keep things under control.
Jason, that's interesting. I just want to draw a line under that point. So it sounds like the demand story when it comes to energy is basically dominating everything right now, all those other narratives, including this geopolitical tension.
Yeah, I think that's it. I think, if you look, we haven't seen a lot of new LNG supply come out. I think it's been soft demand in China, so Asia Pac has been soft. And then the other thing that you've seen, particularly that's affected LNG in particular, is you've had a couple of warm winters. So you're getting a little bit of cold weather in Europe, so you're seeing inventories get depleted a little faster. But last year we finished with very full inventories. Injections all over the past year sort of got them up to essentially full in Europe. And we haven't seen a significant depletion of inventories yet. So the weathers, I think, also contributed as well as sort of economic weakness in Asia.
So does that change, though, if this turns into a drawn-out conflict, if this isn't a short-term matter? Does that impact get compounded over time? And is that sort of a steady sort of rise, or do you think that this could be exponential?
You know, I think as long as it's sort of at the current sort of level where you've got sort of periodic clashes, you don't have wholesale diversions sort of around Africa, for example, people avoiding the Suez Canal en masse, then I think you're all right. I think what could happen, though, is if you see really significant disruptions in the Red Sea, you'd need sort of 40, 50% more tanker capacity to carry the same amount of crude from the Middle East to Asia or into Europe. I'd be surprised if you see a complete cutoff. I think partly because the Houthis don't seem to be attacking Qatari cargoes of LNG. Hamas and Iran have had sort of used Qatar as sort of an intermediary, and I think there's a desire to keep relations on a reasonable footing there. And you also get a lot of crude going south through the Suez Canal, rather, into Asia from Russia. And again, I don't think the Houthis or Iran has a big beef with Russia at this point. So if you get a really significant clash and shipping just stays away, then I think you would see a significant impact. I think if it stays at the kind of, sort of simmering level that it is right now, prices should sort of do what they've done, which is, tick a little higher, but not really spike.
All right, Jason, really great to get your perspective. Appreciate the time. That is Jason Fear. He is
Thanks
Global Head of Business Intelligence over at Potent & Partners. Now, still ahead, U.S. banks kick off the earnings season tomorrow. We'll delve deeper into what we can expect from the big financial lenders. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Paramount and Warner Brothers Discovery. Redburn citing a negative tipping point in linear television advertising for downgrade of both of those companies. Analyst Hamilton Faber says both face material downside, but the risk is going to be greater for Paramount, which gets downgraded all the way to sell. Those shares all the way down by about 6%. Yum Brands up next. The parent company of KFC, Pizza Hut, and Taco Bell hit with an equal rate rating. That's down from a buy rating over at Wells Fargo, with the analysts saying growth this year may be limited. Slower foot traffic and a decline in same-store sales is why he says Yum is, quote, in the middle of the pack among restaurant chains. Those shares, though, only fractionally lower. And finally, let's take a look at MasterCard, getting raised to outperform. This over at Oppenheimer with a 510 price target. Now, when it comes to the fintech sector, the analyst recommends choosing quality over stocks at their current valuations and views MasterCard as one of them. He expects profit growth in 2024 for the company. Investors, at least for today, not buying it down about 0.1%, and those are some of our top calls. We do want to stick with financials right now because a fresh earnings season ostensibly kicks off tomorrow. JP Morgan, Bank of America, Citi, and Wells Fargo among the big banks set to report on Friday morning. Joining us right now to talk a little bit more about what to expect is Jason Goldberg, Senior Equity Analyst over at Barclays. And Jason, before we get into the nitty-gritty of net interest income, interest rates, and all that stuff, I do want to sort of start off here with the idea of what happens in the fourth quarter when a lot of these banks do have to sort of deal with sort of one-off costs, if you will, dealing with staffing changes and things like that. How much of an impact could that potentially have on the earnings we see tomorrow morning?
Yeah, no, that's a great point. It's going to be a really messy quarter. First off, this is the quarter where the banks have to pay the FDIC to cover the losses tied to Silicon Valley and Signature Bank from last year. And for the banks, I think it's like $16.5 billion. For the top 20 banks, it's like $13.5 billion. So right off the bat, you're going to have a fairly significant one-time charge eating into results. And then on top of that, you are going to see other charges. More than half of the top 20 banks have already pre-announced one-off events, whether it's securities portfolio restructuring, severance, the shift in terms of changing some of the cash flow hedges on commercial loans amid an accounting change. So it is going to be a fairly noisy quarter. So when kind of the results hit the tape, I think you're going to have to do some math to determine what the actual bottom line results are relative to expectations.
All right, well, let's get to some of those bottom line results. And a lot of those bottom line results are, of course, going to be tethered to economic conditions. Economic conditions, at least that we know based on the official government data, held up pretty well here. Is that going to be reflected in the earnings tomorrow?
Yeah, no, certainly. You're right. Banks are a reflection of the economy. And I think you've seen a couple of drivers. Clearly, earnings, particularly in the second and third quarter this year, were bogged down by a jump in deposit costs and deposit outflows from the system. As things have settled down, we do think you'll see deposit growth in the fourth quarter. The first quarter in 6, you've seen that. And I think the rate of increase in deposit cost, slowed in the third quarter and should continue to slow in the fourth quarter. In addition, a benign economic backdrop should lead to, relatively only modest uptick in loan losses. So, loan losses for the industry have increased each of the last 8 quarters, be it off of a 50-year low. And we expect losses to continue to grind higher, but remain manageable. Now, banks may opt to take elevated provisions in the fourth quarter as they try to clean up to get to the year ahead. So it kind of gets back to my early comment on messiness. But, one of the things also to keep an eye on is we do think loan growth outside of credit card will be subdued. There is, still some economic uncertainty, borrowing costs are higher, and corporates are, being a bit more cautious in the current backdrop.
I want to talk about deposits a little bit more, and specifically your view that we could see deposit growth, actually. And I'll ask a simple question. Where are those deposits coming from? Are those coming at the expense still of those smaller, those mid-sized banks, or is that maybe some cash coming out of money market funds, since that's one of the other big narratives? You think about that trillion that has gone into money market funds since just March. A lot of that was in reaction to that banking crisis, if you want to call it that.
Yeah, no, I think certainly. I think deposits, naturally trend higher. Clearly, the upheaval in March caused a lot of banks, and you did see some money, flow out of the system, and then money flow from the smaller banks to the bigger banks. But I think a lot of that uncertainty has subsided, right? The industry, I think, after we got through the First Republic failure in May, I think the market realized, most of the other banks are in much, much better position, and some of that concerns that we had earlier last year have certainly subsided.
All right, Jason, great to catch up with you. Going to be a busy few days. Jason Goldberg over at Barclays. Tomorrow morning, Team Surveillance will have full coverage here as the big banks are set to report, including Wells Fargo, Citi, Bank of America, and JP Morgan. All right, coming up here on this program, it is the first day of trading for the 11 spot Bitcoin ETFs on the market. Tim Massett is the former CFTC chairman. We're going to sit down with him to discuss the milestone for the crypto industry and what comes next for regulators. This is The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, there's one thing everybody's been talking about for the last few hours, and that's the approval of these spot Bitcoin ETFs.
Yeah, the game is afoot, I think. Sherlock Holmes would say, right?
Yeah.
So we thought we'd actually go through exactly what happened, what the consequences are with Tim Massett. He's Kennedy School Fellow and former chair of the CFTC. Tim, thanks so much for being back with us. We've talked about this as it was pending. And what I was just saying to Romaine actually is, of all the approvals I've seen out of government, this is about the most reluctant one I've ever seen coming out of the SEC. It was a 3-2 vote, and boy, we had the chair saying they're not so sure about it. At the same time, the traders are going, and as of 1 o'clock, we were over $3 billion in trades. Why is the SEC so reluctant?
Well, I think, Chair Gensler never wanted to do this, but I don't think he really had another path forward, right? They lost the court case with Grayscale. And so I think he realized better to approve them than to try to deny them and basically get forced by a court to do this. So, he sided with the Republican commissioners to approve them. And then, of course, you had the Democrats, the 2 other Democrats voting no. I think the concerns of Chair Gensler and the Democrats are the same, that the the level of investor protection in the underlying spot market is still very low. It's not a regulated market. And, you know, this might help improve the standards. There are ways you can make that argument, but not directly so. On the other hand, I think this is going to bring in a lot of new investors into the market, particularly because I think traditional investment advisors are going to feel more comfortable now recommending Bitcoin ETPs, which is really technically what they are, exchange-traded products, to their clients who want Bitcoin exposure.
So the spot market may not be regulated itself, but one of the things the SEC relied upon was the CME and their regulation of the futures market, and saying that they actually operate in parallel. Does that give you a little more solace?
Well, not a whole lot. I mean, not that I don't respect CME, but CME does not really have any supervisory authority over the spot market. So where they ended up in the approval was to say, well, look, if you're trying to manipulate the Bitcoin spot market, that's likely to show up in the Bitcoin futures market, and therefore we'll see it. But then the question is, yeah, but what are you going to do about it? At the same time, I would say that, look, the fact that big institutions like BlackRock, like Fidelity, now have an interest in that helps. And so I'm hoping that at least over the long term, they can be forces for bringing better regulation to this market. So that's my hope in terms of the silver lining here.
What does that process look like, Tim? And I really mean that from the lens of the investor, who at least to a certain extent is kind of exposed for right now. And if you really sort of read in between the lines of the language of that statement that Gary Gensler put out, he kind of made it clear, you're on your own.
Yes, that's right, Romaine. I mean, look, again, the underlying spot market isn't subject to regulation. And there have been arguments that there's a much higher risk of fraud and manipulation, of wash trading. And all you have to do is read Commissioner Crenshaw's dissent on this to see some of those facts. Now, again, the basis for approving it is that, well, if there is manipulation in that spot market, we'll see it in the futures market, and CME will be aware of that, but not clear what they can do. At the same time, these are now registered products under the 33 and 34 Act, so, that's a good thing.
That's a good thing. I mean, registered ETPs, we should point out, just to be very clear about this. But it's already opened the door to a lot of other areas of the crypto sphere, if you will, that are now seeking to sort of find their own place in this market and maybe even more clarity on regulation. We had a filing, a confidential filing to the SEC from a company called Circle Internet, which of course runs a stablecoin. And it's been made very clear that this isn't just about them coming public to the market, but it's also kind of forcing the SEC's hands in terms of how or if they should be regulating stablecoins as well.
Well, I'm of the view that they should not be regulating stablecoins. Now, they did recently win the case against Terraform Labs, but the issue there, and that was with respect to Luna and Terra, but the issue there was the judge said that, look, it was the coupling of Terra, the stablecoin, with this anchor protocol where people could deposit their stablecoin and get a 20% return. That made it an investment contract. I think if you're still talking about a stablecoin that does not pay interest, that is not something that should be under the SEC. I still think of that as a bank product, bank-like product, that is. It's a payment mechanism, and I'd still very much like to see us create a regulatory framework for that. It's not clear that they can have a huge application in payments, but we should find out.
So does that mean that this might fall under the umbrella of the Fed? Should we actually get to that point?
Well, probably not the Fed. I don't think they want to touch it. I would say more likely the OCC, the Office of the Comptroller of the Currency. And there is legislation, as you know, pending in Congress. The House Financial Services Committee passed a bill. Not likely that we're going to see that make it out of Congress to Biden's desk before the election. But who knows what might happen after the election. But I think we do need to create that framework. Other countries, a number of other countries are creating that framework. I think it's good both to address the risks of stablecoins, because we don't have a framework today that really regulates them except under state laws. And it also potentially allows us to realize the opportunities that stablecoins may pose. But you've got, Japan, Europe, Singapore, the UK, the UAE, all moving forward to create these frameworks for stablecoins.
So, Tim, I think you're making a terribly important point. It's, of course, not just a question of what the regulation is, but who gets to decide. I mean, you say how you think it should work. You're a smart man. You know this better than I do. I'm willing to defer to you, but you don't have the authority to do that. Is it a bit of an embarrassment that we basically have the CFTC, we got the SEC, we've got banking regulation? When is Congress actually going to step in and do this?
Well, that's the $61,000 question, David. I mean, I've been talking about this for almost 10 years now. I hope they would. I hope they would step in by now. There's some greater momentum, but frankly, still, we've got a lot of diversity in viewpoints in Congress. You've got some people who are just very, very skeptical of this whole sector, and they feel that any legislation that addresses the regulatory framework may just legitimize it more, and so they don't want to do that. And then, of course, you've got other people who think there's great innovative potential. They want to make sure we don't over-regulate. So, you've got to find a middle ground there. Again, I don't think we're going to see legislation prior to the election pass, but maybe after that.
Okay, Tim, it's always great to have you with us on these subjects. That's Tim Massett. He's the former CFTC chair. And I must say, I wonder, when you talk about more than $3 billion being traded today, maybe that puts some pressure on Congress. I mean, there's a lot of money involved now.
Yeah, the volume today has been, you expected the volume to be high, but if this persists for weeks on end, at some point they're going to have to step up and address it.
I should hope so. Yeah, there's a lot of people.
but it kind of makes you wonder, too. I mean, when you have an industry or you have a market that forces the hands of legislators and regulators, I'm not sure that's how it's supposed to work.
I'm not sure this was the founding fathers had in mind when they wrote the Constitution. And so Wall Street Week tomorrow, we're going to be joined by Steve Ratner, Willard Advisors Chairman and CEO. We're going to be talking about the investment climate for 2024. That's coming up at 6 p.m. Eastern Time on Wall Street Week.
And of course, you can catch David every day around this time for our Wall Street Week daily segment right here on The Close. And as David was just alluding to, some of the biggest volume movers today are in the crypto sphere. Unfortunately, for a lot of the crypto stocks themselves, they are on the back foot here on the day, though those ETFs are getting a pretty nice bid. As far as the rest of the market here, a mixed bag here for the Dow, the NASDAQ, and the S&P here on the back of that inflation report that showed, well, inflation is still here. A lot more coverage coming up as we round out into the final hour of trading right here on The Close, right here on Bloomberg. This is the countdown to the close, just about 3 p.m. here in New York. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
A mixed day here for the broader U.S. equity markets here with the Russell 2000 mid caps. In fact, a lot of the cyclical names moving lower here on the day. You are seeing some modest strength in the tech names. I don't know if that's related to the CPI report we got this morning, but I'm not sure it provided necessarily the economic backdrop that would necessarily be supportive of buying into cyclicals.
Yeah, exactly. And it's interesting, you really didn't see that March cut pricing budge too much on the back of that CPI. When you did see that reacceleration in inflation, as some have been warning about, but you take a look at the S&P 500 right now, we're just about flat. We were lower on the day, so clawing back there, but still not too much action.
And of course, what continues to be the best performing major indice out there remains Japan, the Nikkei up 2% here on the day, continuing back towards those highs, those multi-year highs, multi-decade highs that we hit a little while ago. We get bank earnings. You saw the KBW Bank Index down a little bit here on the day. But can we talk about spot Bitcoin ETFs?
I was hoping you would bring it up.
How they doing? I know Bloomberg is all over this, kind of loading all this into the system. We are nothing if not data-driven here. The volume is insane on this stuff today.
The volume is insane. $4 billion for the all 11. $4 billion have traded so far. You take a look up at the top. You have Grayscale.
And the crazy thing is, like 2/3 of that was just one guy.
Yes, exactly. Someone with some pretty deep pockets there. Grayscale and BlackRock. Although if it's true, please tell us.
True. Who knows?
But yeah, obviously a historic day and. quite a size and scope. It'll be interesting to see how we settle up versus past ETF launches once trading closes at 4 p.m.
I will definitely be telling my grandchildren about January 10th.
I will never forget where I was. Let's talk about some equities, because why not? We'll start with Tesla, which is an exciting stock. Shares down 2.5% right now. There's a few different stories out about Tesla. Of course, one of them being that Tesla is boosting pay for workers at its California plant. That is as UAW momentum builds. The other story is actually about Hertz, and maybe that's why you're seeing the shares move lower right now.
That's just a crazy story to me.
I know. Hertz.
So they made such a big deal.
20,000 EVs. They're shifting back to gas-powered cars. I think about 80% of their fleet is Tesla. So there you go. Obviously, that's dragging down Tesla.
And we should point out, when they made that initial announcement they were going to buy, there were a lot of people that were very skeptical of that, whether there would be enough demand for it. And I guess now we have the answer.
Yeah.
But Tom Brady, is he going to be okay?
You know, I have a call out to him. He hasn't answered me.
He hasn't? Okay.
But I'm trying. And let's just quickly run through. Coinbase not having a great day. You have some analysts saying that maybe that 400% run-up that we saw in 2023, the actual benefit to Coinbase from these spot Bitcoin ETFs won't be as big as expected. And finally, Chewy. Barclays raising its rating on it to overweight from equal weight, looking to Canada for some additional growth for Chewy.
Oh, okay. All right. Well, whenever you're in trouble, definitely look to Canada. We are 1 hour away from the closing bells here in the United States of America. Our cross-platform coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. 4 straight days in a row, they've both made it into the office. A hearty welcome to our Bloomberg audiences across all of our Bloomberg platforms.
Are you impressed by that?
I am very impressed. Television, radio, originals. I got to get to it all, Carol Massar and Tim Stenovic. And of course, our partnership with YouTube. And also,
I feel like I've been dissed, but that's okay.
Well, the market's getting a little bit of diss right now here. The Russell down about 0.8%. Bitcoin fluctuating between gains and losses on the day. I don't know what you guys have been watching, but I'm told that something big happened just a few hours ago.
Oh, yeah. Those spot Bitcoin ETF started trading.
What are you talking about right now?
Well, all right. We're focusing on that. But, we were just talking about me feeling dissed in the markets. There's a bunch of folks that were former customers of FTX, and they feel a little bit dissed right now. And they're trying to get a judge to basically say, listen, all of those Bitcoins that we had, apparently, I guess the settlement is saying that they've got to value the Bitcoins going back to, what was it, November 11th, 2022, when FTX filed bankruptcy. And they're saying, no, that's not what we want. Look at the run-up that we've seen in Bitcoin. Why don't we get it at today's price? They also, I think this is interesting, don't want to be paid in the digital coin. They want greenbacks.
Okay, that is interesting because they had this in crypto. But I think it makes sense given that back then the price of a Bitcoin was sub $17,000 and now it's upwards of close to $50,000, Romaine. But it raises the question of what would be a fair way to pay these folks back? Would you take an average of the price over a certain period of time? Would you? Because it's you can't really take the highest price and pay them there. I mean, that doesn't really make sense.
Well, the question I had, and this is a fascinating story to me, though, but who actually has custody of those actual coins right now?
Good point.
And I guess that's part of the issue, right? I guess if they could deliver the coins back to them, that would make the most sense. Just give them back to them and then let them cash out if they want to cash out.
Yeah.
But the fact is, my understanding is the court doesn't necessarily have that, so they just basically have to come up with the value and pay out that value.
There's a lot of hard questions there that I don't know how to answer. So I'm going to pivot entirely because there's another really fascinating story on the terminal out right now that actually doesn't have to do with cryptos, but it does have to do with
cryptos?
Cryptos, yeah. Cryptocurrencies, because there's more than just
Bitcoin. Cryptos? Is that what you said?
Cryptos.
Gen Z today, I can't keep up.
It's not Gen Z. Let's put that on the record. Let's talk about EVs. Let's talk about Hertz because Hertz is selling 20,000 of its EVs in a shift back to gas-powered cars. This is quite an about-face. Exactly. And we're showing Tesla there, too, because 80% of their fleet thereabouts is Tesla.
Yeah, 80% of the EV fleet, which is around 11% of Hertz's total fleet. So it's a significant number of vehicles. There's a lot of implications here. I mean, a big part of the story is the changing view of EVs and the experiment essentially that Hertz was doing not working out. Remember when Bloomberg News broke the news of this story back in 2021, this actually got Tesla over $1 trillion market cap.
Yeah.
That's that's now fallen down to about a little more than $700 billion, Romain. But it shows the way that the reception of EVs is not what everybody thought.
It's a sign of the times.
It's certainly not, but particularly in the rental market, and there's been so many anecdotal stories since they rolled this out of how a lot of customers really didn't want them, that some found issues that they couldn't charge the vehicles in a way that they needed to utilize them. Hertz itself made the point that the repair costs on those were much higher than on gas-powered vehicles, which I'm sure must have factored in their decision as well, Carol.
Yeah, they're still going to, though, keep buying. They've got agreement to buy a bunch from GM and Polestar. So I think, I don't know, do we just... I don't know. It says it, but is it just that we have the time frame long in terms of EV adoption? Maybe it's just going to take longer. I don't know, but it doesn't look so good. It's certainly not for Hertz shares today. All right, guys, that's a wrap across platform, radio, TV, YouTube, Bloomberg Originals. We'll see you at 4 p.m. Wall Street time to count you down to the close on this Thursday.
And we continue our coverage here on Bloomberg Television with breaking news. Christine Lagarde, the ECB president, saying that rate cuts in Europe can start once data confirm inflation's path. Lagarde speaking a little bit earlier, saying that she can't give a date for ECB rate cuts, but she does say that they can start once the data confirms the inflation path does suggest it. She also talks about the idea that the ECB has already likely seen a peak in rates unless there's a shock at some point going forward. Again, these comments coming out right now. She also talked about a wide range of other issues, including the stability of the euro, as well as weighing in on the presidential election here in the United States. All right. Let's keep it going here as we count you down to the closing bells. With just about 50 minutes to go. Tracy Chen joining us right now, portfolio manager over at Brandywine Global. And Tracy, actually, let's start off with some of those comments that we heard out of Christine Lagarde, because it really does sort of feed into that broader market narrative globally, that the peak in rates is certainly behind us, and that there is a case to be made for anticipation of rate cuts sometime soon. What do you make of that?
Hi, Romain. Nice to meet you. Yes, I think if you listen to Lagarde, I can see that I do think the rates have peaked here. But the problem is I think year-end rally has been too aggressive in pricing too many cuts and too quickly. The central bank will cut rate. So, and today's inflation number tell us that inflation can be very sticky, especially the service components. And if you look at inflation swap and inflation break-evens, they have been oversold. And any geopolitical hiccup can make inflation higher again, right? Like oil price, like what's happening in the Red Sea. And if you look at the small business, their compensation plan and also their expectation of inflation is flaring up again. So I think the market has been extrapolating the inflation data, and inflation data has been lagging, is a lagging indicator. So I think too much complacency in the inflation market.
Absolutely. There is a broader economic question about the stability of the economy, whether it's here in the U.S. or overseas. And I do just want to clarify, too, with those Lagarde statements, that was actually coming from a TV interview that she did with France 2. But in that interview, she also kind of talked about this idea that some of the recession risk that were so prevalent just a few months ago, maybe, at least in the minds of a lot of investors and economists to boot, that has lessened. And at least in her words, she says the euro area is not at risk of a serious recession. And we know here in the U.S., if you believe economists, they don't think we're probably going to hit one at all, at least not in 2024.
Right. I concur with that. I think the U.S. economy has been very resilient and will probably be so this year. If you look at household, which the consumption is a majority, is a major contributor to the GDP growth. Household has been, their balance sheet has been very healthy. If you look at the household net worth, it's about 7 times of disposable income, and household savings deposit has been much higher comparing to a pre-COVID time period. And also we still have residual fiscal spending flashing around in the economy. And this is the election year. You can see fiscal impulse continue to stay strong. So, and financial condition has been easing since the end of last year. So that definitely helped a lot. And recently we have been hearing some talk about the Fed is more mindful about the impact of QT in terms of the liquidity impact. So they might consider ending QT sometime this year. So I think that should be another boost to risk assets.
Well, Tracy, let's bring this conversation to the market and specifically to the fixed income market, because this line in your notes caught my eye, that you talk about credit spreads. They're getting very tight, both if you look at investment grade and high yield. But at the same time, you take a look at all-in yields, still attractive. And how should investors be evaluating the bond market at this juncture? Should we be looking at spreads or should we be looking at yields?
I think probably we'll have to look at both because for certain sectors, the spread has been very tight, even compared to pre-COVID level. But the other sectors, certain pockets of the credit market has been looking relatively cheaper. Their spread level are still wider than the pre-COVID level. But again, you also look at all-in yield, right? And if you look at certain securitized market like subprime auto ABS, credit risk transfer, and also agency MBS, and also some new issue BBB CMBS, their all-in yield are actually mid-high single digit or even double digit, without a lot of credit risk embedded in. So I think that those sectors should actually benefit in terms of spread tightening and also the compression of all-in yield this year.
So those are the sectors where that sort of math, that calculus does make sense. Where would you avoid, though? What just looks outright expensive?
I think relatively, if you look at the compensation, the extra compensation of some IG corporate or some high yield, the compensation of for those bonds versus the cash T-bill is getting very, very tight. Even though the all-in yield still looks good, I think investors should be cautious on some of those sectors.
All right, Tracy, always great to speak with you. Really appreciate your time. That is Tracy Chen. She is portfolio manager over at Brandywine Global. Now, we do want to bring you some breaking news. This back to the story of the day, those spot Bitcoin ETFs beginning to trade. Some breaking news from our Bloomberg News colleagues that Vanguard's brokerage arm will not offer trading in ETFs that directly invest in Bitcoin. That is according to a spokesperson. You take a look at Merrill apparently still evaluating whether to provide that service, according to a spokesperson. On the other side, you do have Charles Schwab offering Bitcoin trading. So it's a story that we'll continue to keep an eye on. Coming up, though, on the close, we'll take a look at why Bill Belichick is parting ways with the New England Patriots after 24 seasons, 17 division titles, and 6 Super Bowl wins.
Plus a focus on Africa, the investment potential there with the actor and entrepreneur Boris Kodjoe, co-founder of the Full Circle Africa Economic Conference.
And Elton John auctioning off millions of dollars in art and antiques over at Christie's. We'll tell you what's up for grabs. All that and more coming up. This is The Close on Bloomberg.
All right, welcome back to The Close. We're counting you down with a little bit less than 45 minutes to go. Let's get right to Abigail Doolittle, who's standing by now for our Options Insight segment. And Abigail, you're taking a look at what has changed in the 2 weeks since we started the new year.
It is pretty amazing, Romaine, that we have had such a change between these 2 years, 2023 and 2024. Something that they share in common is the trading direction is not exactly what folks expected coming into either of these years. Last year's rally not anticipated, and this year's nascent weakness, a little bit of a slide, especially for small cap, also not anticipated. Let's bring in Eric Metz, president and CIO of Spider Rock Advisors. Terrific to have you with us, Eric. Thanks for joining. And what do you make of this transition? And also, does it remind you at all, because some of our other guests, it reminds them a lot of the move between 21 and 22?
Sure. Thanks again, Abby, for having me. I think there's two things to think about. One is just the positioning, right? There's a ton of cash on the sidelines, which has been accumulating. And then with the front end of the curve, really after rates had risen in the back half of 21 and 22, just where people are appetized to deploy capital. And so I think there's a lot of folks that were maybe bearish, given valuations, given interest rate, equity risk premium, et cetera. But as you think about the 2 years, I think the correlation from our seat at Spider Rock is just where volatility plays a role in people's risk management and portfolio construction, but also where people are being sometimes caught off sides. And I think both years are indicative of that.
And if you could actually briefly tell us about Spider Rack, because it's pretty interesting what you guys do. I don't know anybody else who does what you do for portfolios relative to volatility.
Yeah, I appreciate that. You know, the vision of the business was simply to provide after-tax solutions and really incorporate private wealth portfolios with listed derivatives. And so the biggest nuance to our business model is being able to place our work as an overlay onto people's accounts. And so there's a large infrastructure and technology chassis into the private wealth channels, think Fidelity, Schwab, UBS, Merrill Lynch, et cetera, where we can see clients' holdings and then place calls and puts accordingly into those direct accounts. And the main thing is the taxation, right? Everybody's got, I'll call it a bull market that's mildly long in the tooth with a fair amount of embedded capital gains. So how do you treat that with an after-tax mindset?
It's really interesting, that idea of having an overlay with portfolio management. There's so many overlays, but the idea of doing that through derivatives. So speaking of derivatives, volatility, the VIX, right now it still seems pretty subdued, but a lot of folks, and I think including you, think that this year volatility could spike up a bit.
Yeah, I think where there are some similarities in some elements of the market between the 2 years, I think volatility is actually one that's different, right? We began the year of 2023 having oscillated really with a high level of vol in 2022, call it oscillating between 20 and 30 most of the year. And so that dissipated and waned down throughout that year and began 2023, roughly speaking, probably in the low 20s, and now we're sitting at 12. And so how to incorporate that in risk management, how to incorporate that in really solving objectives on an after-tax basis for our clients is our core work. And so yes, I do think there's a good rationale to see volatility rising this year, namely the Fed's on what I'll call data watch with inflation kind of in scope. When you take that coupled with valuations, coupled with, like I mentioned earlier, the equity risk premium, somewhat nascent in a lot of folks' lens, volatility is poised to rise. If there's anything that QE did, it was dampen volatility, so quantitative tightening should prevail and in the opposite metric.
So in terms of those overlays, then, if you think volatility is to rise, and I believe more so toward the end of the year into the presidential election, what is the composition of those overlays right now? Are there more puts in there, or are they tailored to each portfolio?
It's the right question. I think it's a complete function of our clients' objectives, right? An institution's going to have very different objectives than some of our private wealth clients from a tax perspective. But at the end of the day, the most common metaphor for our work is an insurance policy, right? So a lot of folks have insurance policies on their cars, their homes, their lives, but maybe not their concentrated stock position, let alone their whole portfolio. So when insurance gets, I'll call it relatively cheap, as we're seeing today, there is an opportunity to invoke that in your portfolio.
Very, very interesting. Eric Metz of Spider Rack, thank you so much for joining us today for Options Insight and conversation on these derivatives overlays and, of course, volatility. From New York, this is Bloomberg.
Sir Elton John and his husband David Furnish are auctioning off $10 million worth of art and antiques. That's after selling their Atlanta home last year. If you take a look through the article, what's actually being sold, you could get some 1970s era silver platform boots Romaine. Those might look nice. Apparently this 1990 Bentley two-door convertible. Do you have one of those?
I do.
Okay, yeah. Well, okay, so maybe this isn't for you, but I'm sure a lot of people will be psyched. Apparently 900 lots that all total about $10 million.
Yeah, I was going through all of these things, and I mean, obviously, given a man of his taste and style and wealth, he's got a lot of good stuff in here. I'm really interested in a lot of the artwork prints. I mean, he's got the collection of photography that he has is insane. I mean, just some of the most prolific and most important photographers probably of the last 70, 80 years he has there. But the one that struck out to me was, and I'm going to quote here, there is also a significant amount of Versace clothing.
A significant amount.
What exactly does that mean?
He's buying Versace in size.
But enough that they're going to have a whole separate auction that's just devoted to his collection of Versace stuff. So,
that's pretty amazing.
Yeah.
My big question is why? I know that he's selling his home. It's tied to selling his home, but you'd think that he'd want to hang on to some of this stuff. I don't know.
Well, it says
it's
basically an entire year of Versace shirts.
Wow.
But this is just one. This is just one of his homes. He's selling the home in Atlanta. My understanding, just based on the reporting, is that this is all stuff that's contained in that home. I assume he's got another collection of Versace shirts at his home out in LA and in London and wherever else.
That's what I was going to say. If this is what he's selling, what he's giving up to the public, what's in the personal collection that he's keeping? There must just be some amazing pieces in there. I have to say, reading through the article, the one that catches my eye is the 18-karat gold, diamond, and orange sapphire Rolex Daytona with a leopard print face and wristband. That's estimated at 40 to 60 grand. So I don't think I'm going to spring for it, but still.
How much are those glasses right now? That's what I want to know. Those are pretty cool. We had a guy on air the other day.
Dave Nadig.
Dave Nadig.
Yeah, just yesterday.
I know. Did he know? Did he get those from Elton John? I mean, he just had the colors, but he didn't have the little diamonds or rhinestones, whatever those are, circling them. Dave's got to step his game up.
Maybe Dave is stepping up and looking through this auction lot, because a lot of good stuff here. So there you have it, Elton John.
All right, a lot more coming up here on the close. A refocus on the markets as we count down to those closing bells. Just about 30 minutes away here in New York. This is the close on Bloomberg. This is the countdown to the close. Just about 30 minutes left to go here in the trading day.
And you take a look at the S&P 500. Feels like it can't quite get out of its own way. Currently off by a little bit right now. You take a look at the sector level. There's a lot of red on this screen behind me. Infotech still up at the top. Technology trying to hold on to that 0.4% gain. Energy actually managing a green day. Of course, that sector has been under a lot of pressure the last few days. You go down the list into what's not doing too well, and there's plenty to pick from. Financials off by 0.5%. Of course, we kick off big bank earnings tomorrow. Then you have real estate and utilities at the bottom, Romaine, off by about 2.4%.
Yeah, we talk about those bank earnings. Wells Fargo shares slightly lower here on the day. We should point out most of these bank stocks have had a pretty good run up heading into the earnings season. But of course, that starts tomorrow morning here. So it'll be interesting to whether they actually have the corporate fundamentals to back up that big increase in price. Salesforce shares getting a nice bid today on the back of an upgrade. And we're also going to get earnings tomorrow out of some non-banks. That includes United Health as well as Delta Airlines. But I do want to go to some breaking news that just crossed the Bloomberg terminal on Tesla. We're now learning that the company actually plans to halt some production out of its plant in Berlin, Germany, primarily because of the disruptions in that Red Sea shipping lanes. Remember, they have a big factory over there in Berlin. According to Reuters, they're saying that starting towards the end of January, they will halt production at least through February 11th as they try to work out some sort of situation as to how to get any cars produced out of that Berlin factory to the rest of the world. We should point out that that 2.5% drop that you're seeing in the shares right now, the shares were already lower by about that amount prior to that headline running, but something to keep an eye on. All right, we do want to stay global here and talk a little bit more about what's going on outside of the U.S., particularly in emerging markets. The Full Circle Africa Economic Conference took place in Ghana just last month. It brought together government officials, business leaders, and celebrities together to not only to celebrate the culture and heritage of Africa's position as a hub for innovation and advancement, but also to talk about how to push it even further. We're pleased to have one of the visionaries behind that event, Boris Kodjoe. You all know him, of course, as an actor and a model, but he's also an entrepreneur, and he was the co-founder of the Full Circle Africa Economic Conference, and he joins us now. Boris, great to have you here on the program.
Thanks for having me. Happy New Year.
What was the impetus behind this? I know you have your own cultural ties to the African continent, but what really got you interested in doing something like this?
As you said, my father is from Ghana, so I was visiting as a young boy, and I was always annoyed by the old stereotypes and old narratives that people always had about Africa. These perceptions about Africa being all about mud huts and zebras and mass exodus to Europe, poverty. So I wanted to do something about that. I want to counteract that narrative. The first time we did Full Circle was at the request of His Excellency President Nana Akufo-Addo of Ghana, who wanted us to create an event to celebrate the year of return, 1619. So we brought in about 125 notables from the diaspora to reconnect with our ancestry and celebrate our collective heritage, which turned into a huge tidal wave of attention and interest in the continent from around the world. So much so that Ghana went from 40,000 tourist visas in 2018 to 1.2 million in 2019. And we took that as a sign that it was time not just to change the narrative, but also to have a mindset shift from charity and aid dependency to economic development and investing in the continent. Mm-hmm. And that's why we sort of see ourselves as a catalyst to drive economic development and investing in Africa across sectors, whether it's infrastructure, real estate, content. The goal is to show Africa in its vibrancy and diversity with the entrepreneurial spirit that comes with the youngest continent in the world. Yeah. The average age is 19 years old. So we wanted to showcase that and celebrate our heritage in the process.
I am curious about where the money and the investments are coming from. The last time I was in West Africa for an event in Dakar, there was a lot of talk among some of the entrepreneurs there about kind of keeping things in-house, so to speak. The idea that they didn't necessarily want the big European telecoms involved, at least not in a way that they control the assets. They didn't want the big U.S. companies involved in a way that they controlled the assets. How much discussion has there been about that and how you sort of provide investment opportunities for people outside the country without giving up control?
You know, the brain drain is a real thing, and we wanted to make sure that we protect and empower our talent on the ground and really focus on exporting goods and services rather than talent. So keep the talent on the continent and export goods and services. And whether you look at the content as a sector, the entertainment industry as a sector, or real estate, manufacturing, agriculture, and of course tech, the innovation and the progress that's been done in Africa is astonishing. So we wanted to get investors to understand and see the progress and the innovation that's been made in Africa, and sort of lose the fear of taking a first step in investing. Of course, regulatory measures as well as financial infrastructures are very important, but sometimes the private sector has to take the first step and show governments how to be proactive rather than reactive.
Well, Boris, on that note, of course, you had your first Full Circle Africa Economic Conference last month, this past December. What were some of the big topics of conversation?
The topics range from demystifying investing on the continent to youth empowerment, women's rights, housing, urbanization. So we had a bunch of different panel discussions and experts who were sharing their expertise and solution-based dialogue. We also had great keynote speakers like the amazing Pulitzer Prize winning author Nicole Hannah-Jones, as well as the CEO of Sands Technology, Fred Swanico, and of course, His Excellency, the President himself spoke. So it was really a great moment in time that signified and symbolized that Africa is in a pre-IPO phase, I like to say.
We were speaking on this program a couple of days ago this week, Boris, with the big investor in Africa, Runa Alam, who runs DPI, and she was really talking about the demographic changes, and now that's really going to be a big economic driver. You mentioned there's the young population age in a lot of these nations, including in Ghana here. How do you make sure, though, that just having a large young population does not necessarily translate automatically into economic success, as we've seen in India, even in China and some other countries? How do you avoid some of the mistakes that maybe those countries made as they sort of grew into what they are today?
You know, I think access is a huge part of that. Education is the foundation of creating that access. I mentioned Fred Swanico, who's done an amazing job through his African Leadership Group and university to educate hundreds of thousands of computer engineers, for instance, who are now able to work outside of the continent. Connectivity is another point that needs to be discussed, because you got to remember we have over 1 billion devices in Africa through which people consume content as well as bank. That's about twice as much as the United States and Europe combined. So the combination of the young average age of a workforce plus the connectivity gives us a lot of opportunities on the continent to make great strides.
When we talk about where the next opportunity is here and the next conference, and more importantly, where the next money comes into, do you think it's going to be more about fintech, or about telecom, or about natural resources, or about tourism? Where?
It's everything. And it's funny you mentioned tourism last, because I think tourism is the foundation that touches all of these sectors, because you can't sell somebody a house they haven't seen. So, and we really felt that impact when we did it first 4 years ago. When people come over there, they bring on average $2,500 to $2,700, and that infuses the economy at the local level. So if you're talking about SMEs, if you're talking about the hotel industry, it's all based on more people coming to the continent. And that's why we keep talking about changing the narrative and making people understand that some of those old narratives and old stereotypes that we've been fed over the years have been flat out lies to keep us away from the continent and to keep us away from those opportunities. So we have to switch that up, and we have to understand that not only is Africa an emerging market, it is a full-blown market, especially now that the African Continental Free Trade Area has been established. It's one trade union that's multi-trillion dollars worth in trading opportunities. So it's really counteracting the fear and the hesitancy, and understanding that this is the continent to be in now.
All right, Boris, that's a good place to leave it. Really appreciate your time. Hope to have you back soon. That is Boris Kodjoe. He is actor, entrepreneur, and co-founder of the Full Circle Africa Economic Conference. Now coming up, it's the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg.
Spike in shares of DocuSign right now on the back of a report from Reuters that the company has actually fielded offers to go private. Bain, Hellman and Friedman, two big private capital firms, are said to be vying to buy DocuSign. This is according to a report by Reuters, which cites people familiar with the situation that they did not identify. Those shares have spiked about 11% off what was effectively the flat line here on the day. Right now, about a $12 to $13 billion market cap. We're going to try to get you some more details on that. But once again, private capital firms, Bain, as well as Hellman and Friedman, said to be vying to buy DocuSign. Katie?
And of course, we'll continue to follow that story. But for now, it's time for the top three. Every day at this time, we do a deep dive into the people at the center of today's top story. Scarlet Food joining us now. Who are you watching?
I'm watching Bill Belichick, longtime head coach of the New England Patriots, parting ways with the franchise after 24 seasons, 17 division titles, and 6 Super Bowl wins. He earned more than $200 million with the franchise. But since Tom Brady left the team, things haven't gone so well.
Yeah, kind of lost the magic there. I'm told that as a Jets fan, according to my family members, I'm supposed to be very happy about this. So I don't know. Bill Belichick retiring. Romaine, who you got?
What about Cleveland fans?
I don't know.
Oh,
what
okay.
about Cleveland fans?
Well, I'm looking at somebody who maybe is a little bit less, maybe he's more miserable than Bill Belichick. Who knows? Actually, this is Ian Dodd. He used to be the head of recruiting over at Goldman in London, suing the company, saying that they pushed him into, his words, mental and a physical health crisis because of the chaotic work environment. Now there's a lawsuit. There's going to be a trial starting in 2025. Goldman actually pushed back, saying that if there was any sort of distress, it was on him.
Oh, my goodness. That'll be definitely one to watch. I do want to go back to sports, though, and talk about golf, because Patrick Cantlay, so I have my eye on, the PGA Tour golfer. He's signing a deal with Apollo Global Management to be the firm's first brand partner. There you go, Apollo breaking into golf.
He's switching from Goldman because he previously had a sponsorship deal with Goldman to promote Marcus. That ended, so now he's going to wear a hat that says Apollo.
There you go.
All right, Patrick Cantlay, can I get one of those hats?
I'm sure you can.
If you can get a sponsorship deal, sure.
We are counting you down to the closing bells. Just about 14 minutes before we get there. Richard Bernstein, he's the Chief Executive Officer over at Richard Bernstein Advisors. He's up next. This is Bloomberg. This is the countdown to the close. Romaine Bostic alongside Scarlett Fu with about 10 minutes until we get to the bells. Another mixed day for markets with the Russell 2000, those cyclical stocks, the biggest laggards here on the day.
Yeah, it's kind of fitting, given the inflation data we got today, that we ended 2023 with faster than expected inflation, given the economy defied expectations of a recession and surprised everyone with its resilience. Not much movement in equities. The 10-year yield below 4% at the moment, down 5 basis points, but it's really been fluctuating around all day long. And I've been keeping an eye on GBTC. This is the most actively traded Bitcoin ETF by value. I last checked more than $1.8 billion in shares changing hands. Of the 11 spot Bitcoin ETFs that began trading, GBTC is the only one that already existed originally in trust form, so it's got, a captive investor base.
Yeah, it'll be interesting to see whether we actually see continued momentum here. IBIT is the biggest mover here, at least among the main ones that got approved. We should point the crypto stocks themselves, maybe a bit of a sell the news event, all taking it on the chin today with Coinbase down about 6%, Marathon down about 13%. Let's get right to our next guest, Richard Bernstein. He's the Chief Executive Officer and CIO over at Richard Bernstein Advisors, joining us to help count down to the closing bells. We got about 9 minutes to go here, Richard, and Scarlett started off talking about economic conditions. We got an inflation report today, and I think when you piece together a lot of the different economic reports that we've gotten, has it changed the narrative at all based on what the market has priced in?
So it's interesting, Romaine. The economic data has actually sort of troughed. If you look at the OECD leading economic indicators, they've actually begun to reaccelerate slowly, but they're reaccelerating. The Conference Board's leading indicators are basically stopped going down. They're flat. So in a world of better or worse, it's clear the leading indicators are getting better. With respect to the inflation report that we got today, I think it's important to point out that the trough in the year-to-year change in the headline CPI was back in June. So again, it's not rampaging upward, but it has troughed and looks like it's starting to climb up again. Now, one could say that that's not going to continue. I get that. But I think the interesting thing is that the Fed, economists, everybody seems to be raising the mission accomplished banner with respect to inflation at a point in time where it's actually troughing and potentially going up again. And the leading indicators seem to be showing there's going to be more strength rather than less.
So where does that leave the Fed then? And more importantly, where does that leave all these bond investors or options investors who have basically priced in 5 or 6 rate cuts? I mean, if that is the case, and particularly, and I just point out real quickly, Richard, this isn't just about the economy. I mean, if you look at some of the expectations for corporate profitability, that's going to complicate things next time the Fed sits down and talks about this.
Right. Well, Romaine, I think the corporate profits one is a very interesting thing because, our forecast here at RBA, Richard Bernstein Advisors, RBA, our forecast that corporate profits, which were down about 10 to 15% in 2023, are going to be up about 10 to 15% in the next several quarters. And, a lot of the easing that we've seen in the labor markets has come during that profit recession. So when profits are down 10 to 15%, companies tend to fire. But when profits are up 10 to 15%, companies tend to hire. So a lot of the weakness that we've seen, which really wasn't a lot of weakness in the labor market, is probably going to reverse for the next couple of quarters, which will make the Fed's job a little bit harder.
Yeah, you're talking about an inflationary impulse that we can anticipate here. Speaking of inflation, you point out certain pockets of costs are rising, like shipping, for instance, or they're pretty well supported, like metals prices. How and when do you expect this to show up in corporate earnings?
Yeah, I think to some extent, Scarlett, it already is, right? We've seen the worst growth rates in corporate profits probably about 2 quarters ago, I'm going to guess, more or less. I may be off by a quarter, but more or less 2 quarters ago. And they're starting to improve. So I think some of the better pricing environment is already starting to affect corporate profits. I mean, the NFIB small business survey that came out the other day showed that pricing intentions, like 3-month forward pricing intentions, are revving up. That's important because that 3-month pricing intention tends to lead the headline CPI. So the Fed's job, I think, is going to get harder, not easier, over the next several months.
Yeah, it makes what John Williams said yesterday pretty prescient when he was stressing the idea of higher for longer. It certainly feels like the CPI report dovetails with that nicely. You see 2024 as a year of a return to fundamentals, but to what extent did investors rely on or look past fundamentals in 2023? Because 2023 worked out pretty well for anyone who was just passively invested in, say, big cap stocks like the S&P 500. And, you kind of go with what worked for you.
Right. Well, absolutely. I think the thing that we tried to point out to our investors is that the so-called Magnificent Seven, which I'm sure everybody is all too familiar with, there's nothing really magnificent about them. They're not superior growers. They don't have superior balance sheets. They have strong growth and strong balance sheets, but it's not unique. There are a lot of other companies that share those characteristics. And so what we're really seeing is a more speculative, momentum-driven market that's focusing on 7 stocks. Our argument is, are there really only 7 growth stories in the entire global equity market? Well, we've shown our investors that's not true. There are hundreds of companies that are growing at similar rates of growth, whether it's in the United States or outside the United States. We're actually shown that. So we think the breadth of the opportunity set, if you will, is extraordinarily broad right now, and I would argue historically attractive.
But I mean, you understand psychology, investor psychology too, Richard, that a lot of people, they want to just kind of look at, where the sort of herd of cattle is going and just kind of follow that. And that's always been the case, at least for those folks that aren't brave enough to sort of do their own research and make their own investment decisions. I am curious as to whether we fall back into that trap, particularly if we do run into some sort of gray swan or just some sort of speed bump, whether it's geopolitics or maybe just some other sort of development going on in our supply chain and whatnot.
Right. I like the gray swan. Is that an older swan? Is that a reference to
older and wiser?
But anyhow, no. I get your point. And I think for some people that will be a safety blanket, and a security blanket rather, and I think they will run back there. But history says that when you get periods of volatility, you tend to get changes in leadership. And so if we do get a market that is highly volatile, which I think is what you're saying with respect to a black or gray swan, I think the odds are we will see a change in leadership.
All right, Richard, always great to talk to you. Are the Rangers going to hold out for the rest of the year? This is it? This is the big year for them?
Look, as a Ranger fan, I'm going to say, of course they are. Of course they're going to be fantastic. The cup is coming our way this year.
Oh, you just said it. Wow.
All right. We have
I curse the team.
We have that on tape. Richard, we're going to check in with you, I think, come Stanley Cup time. Richard Bernstein, Chief Executive Officer and CIO at RBA, as he calls it.
He's a brave man. I would not say that out loud. I think that, but I don't say it out loud.
I didn't want to ask him, though, about some of the other New York teams that he may or may not be a fan of. Anyway, we are moving closer to these closing bells. And we talk about a market that's kind of a mixed bag. I mean, basically, the S&P is unchanged. But when you look at some of those cyclical stocks really start to get sold off a little bit, despite the fact we had that big embrace of them, I don't know, a few weeks ago. Kind of interesting to see where investors' minds are at. Stick with us. We're going to have a full breakdown of everything that's been taking place today as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help us take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms on this Thursday afternoon. A mixed day here for stocks, a bid coming into treasuries, and wow, an incredible day in terms of volume and volatility for the crypto space.
Yeah, absolutely. And maybe no surprise, right? When it comes to the crypto space, we see volatility. I don't know if you guys saw this, though. The most read story on the Bloomberg, it just crossed a little while ago. Credit card delinquency rates have exceeded pre-pandemic levels. This is from the Philly Fed. So it's interesting. We continue to see signs that consumers are definitely feeling some stress here.
Okay, Bank of America, Wells Fargo, JP Morgan, Citi, all reporting tomorrow morning. You guys know this. I beat this drum every quarter. What I want to hear from these companies is how consumers are doing, the cash that they have in their accounts, what they're doing on their credit cards, and if those delinquencies are rising.
Yeah, and all of that is driven by this perception that things are not necessarily getting less expensive. The CPI report today was hotter than expected. My favorite quote that I read today was, "It was not great news for stocks, but it might not be fatal either," which kind of explains the price action, too.
Yeah, it'll be interesting, too. I mean, I assume you're referring to that Philly Fed report. Yes. And I thought it was interesting, too, because, I mean, every time we bring up that increase in delinquencies, we always have all these people come on the program, and they talk about this ratio isn't as high as it would have been during the financial crisis, and even delinquencies are higher. It's not necessarily across the board for consumers. So it's always hard to know whether this increase in delinquencies, this increase in credit card balances is something to really get scared about.
No, it's absolutely, and hopefully the banks can give us some clues as to whether or not they are concerned about what consumers are having to deal with in terms of their own personal debt.
Yeah, and we're going to talk a little bit more about that as we do get those earnings kicking off tomorrow morning. As for today, a relatively muted day for U.S. equities. And wow, take a look for those folks watching our television now. Those percentage changes on the day, it's basically unch across the board. The Dow Jones Industrial Average higher by 15 points, so it's in the green. That's a uptick of less than 0.1%. The S&P 500 lower by less than 0.1%. The Nasdaq basically unchanged on the day because it's just such a small margin. You can't even calculate it on a statistical basis. A little bit more activity when it comes to the price action in the Russell 2000. That did close lower, more meaningfully, 15 points lower, 0.7%.
Yeah, unchanged. But if you look at the S&P 500, I mean, not huge, but about a 1.2% gain from peak to trough, if you will. And if you look at the S&P 500, Scarlett, you've got about 216 names to the upside, 284 downside, and 3 unchanged.
And just real quickly, too, I think it's interesting, too, because we came into this morning, one of the big meetings we had here at Bloomberg, we were talking about this run back to a record high for the S&P 500. And every day it seems like it's going to get there, and then you sort of bump up into this resistance.
Can I tell you what the S&P has done so far this year? Anyone want to take a guess without looking at the terminal?
I'm going to say unchanged.
Up 0.2%.
It's in the green.
Wow.
So unchanged.
Gotta go check my 401k tonight.
I know. Well, the Dow is up 0.06%. How about that? All right, let's take a look at the sector
I'm going to have
performers.
one of those steaks, one of those Zuckerberg steaks, you know, with the, what was it, macadamia nuts and beer?
Yeah, that sounds kind of good right now. All right, let's talk about the best performing and worst performing groups here. Consumer durable and apparel up 0.9%. Software services and chip companies each gaining at least 0.2%. On the downside, telecom losing more than 2.5%. Autos, that's really Tesla dragging that group lower, down by 2.5%. Utilities also in the red.
All right, guys, let's get to some of the individual gainers in today's session. Netflix, number 1 in the S&P 500, number 2 in the NASDAQ 100, finishing with a gain of just shy of 3%, but off its highs of about 5.25% earlier in the session. What happened was you also saw this options calls also surging to about $500. It was led by $500, I should say, $500 calls. So Netflix, $492 and change, finishing the day. A note from Citigroup out, citing optimism about the company's ad-supported subscriber tier, saying a recent update from the company, which I believe happened at CES earlier this week, suggests Netflix's ad tier has seen an acceleration in adoption, right, Citi. So putting that out. They've got a neutral rating and a price target of 500. So we're almost there when it comes to Netflix.
Are you on that Netflix ad on the advertising tier, or you actually pay?
No, I pay.
I think we pay.
Yeah.
Well, you'd see ads if you didn't. What about you guys? Any of you guys do ads?
Too many out there.
No. I just pay for not have ads.
It's kind of frustrating.
Yeah.
We've gotten spoiled. All right, so let's move along. The number 3 gainer in the S&P 500, also among the top gainers in the NASDAQ 100, Palo Alto Networks, again, moving up to its highest level since July of 2012. You might remember yesterday, Morgan and Citi both raising their price targets on the stock, so that one finishing with a gain of about 2.3%. Marvell Technology up in a top name, number 1 gainer in the NASDAQ 100. Semiconductor, as we know, B of A raising its price target to 80 from 68. Maintaining a buy rating, telling investors that the firm's discussions with NVIDIA and Marvell were very positive at CES. So they were talking about 2 different companies, but so they kind of liked what they heard. So Marvell, an outperformer. And I just want to throw in Hashtag's Bitcoin Futures ETF, DeFi. That one is actually higher on the day, about 2.5% to the upside. Just thought I'd throw in one of those names.
You had to do a little bit.
We've been looking
Bitcoin.
at them.
Yeah, 1 of 11, right?
Yeah.
One of 11.
What's the year-to-date gain, Carol?
Very funny. You're funny today.
Oh, thank you. Just today.
Just today.
Hey, let's look at some of the decliners here.
Tomorrow.
I think I'm not feeling well. I'll let my bosses know.
Okay. Let's start with Tesla. You heard Scarlett mention this as one of the drags in the S&P 500 today, down 2.9% on the day. A couple of big news items relating to Tesla worth keeping an eye on. The latest, that Tesla will halt most car production at its factory near Berlin. That's happening later this month and into February due to a lack of components over supply chain issues related to the conflict into the Red Sea. The other big story that sent shares lower this morning was that Tesla is boosting pay for its U.S. plant workers. This according to a flyer posted at Tesla's facility in California that our colleagues here at Bloomberg News saw. We don't know how much of a raise workers will get, though it did say they'd get a, quote, market adjustment pay increases. Just the latest bump in a non-union automaker here in the U.S. and one that the UAW is trying to unionize. Also, we learned in a filing this morning, we were talking about Hertz earlier, that they're planning to sell 20,000 EVs, many of which are Teslas, and shift back to those gas gas-powered cars. Tesla finishing down by 2.9%. Hertz, by the way, falling 4.3%. And then sticking with transportation, let's look at Boeing as we continue to monitor the fallout from the near calamity last Friday on that Alaska Airlines 737 MAX 9. Boeing down 2.3% today. The latest is that the FAA opened a formal investigation into Boeing and said the company's, quote, manufacturing practices need to comply with the high safety standards they're legally accountable to meet. And I will end with crypto and look at shares of Coinbase, which actually reversed earlier gains to fall 6.7% today. There is debate over the effect that the ETF approval will actually have on Coinbase. Some analysts say that it will be a net positive for Coinbase because they're custodians for some of the ETFs that hold Bitcoin. Other analysts say, well, it's actually a net negative for Coinbase because if you can buy Bitcoin so easily using these ETFs, then you don't have to pay the fees that Coinbase actually charges you when you buy that Bitcoin and other crypto on Coinbase. Shares falling 6.7% today. We should note that Coinbase shares were up nearly 400% last year, by the way. So take this move with a grain of salt.
Yeah, I do wonder how much of this was kind of sold in the news. We should point out, like Marathon Digital ended the day down about 13%. Riot was down 16%. Hive was
but what about
down
that
about
reversal
8%,
that we saw?
And back was down about 10. I think, I mean, who knows? I mean, but I do think that some of this is just kind of the repositioning. You had so many people that were trying to front run this announcement by the SEC. Maybe some of those people cashed out and new people cashing in. And well, we'll see what happens over the next few days. Let's check in on what's going on in the yield space here. We did actually see some activity there here. A shift in the yield curve once again here as we continue to see it, but this time is to the downside. 9 basis points on that 2-year yield, and that you can definitely thank that CPI report that we got this morning here for that move, as now a lot of people are having to really rethink their rate expectations as it came in, I guess you can call it hot, if you will. It was higher than, I guess, what economists expected, not necessarily too outsized. All right, guys. Tomorrow starts earnings season officially.
Finally.
I don't know how you're going to celebrate. I'm going to celebrate by taking the day off, but we do get some big names, including JP Morgan, Bank of America, Citi, BlackRock, Wells Fargo, I don't know, if you have Delta, United Health, a bunch.
Yeah, it's been a long week already. I mean, we've had some pretty big data points, right? Whether it's CPI, whether it's the start of the Bitcoin ETF, the approval of Bitcoin ETFs, and then the start of trading for them, and now bank earnings as well. I was going to throw in the 30-year Treasury auction, but that didn't actually really move things today.
Yeah. Well, I'm just looking at the bank stocks that are going to report tomorrow. I mean, Bank of America ended down about 1.3%. JP Morgan was down about 0.5%. Wells Fargo pretty much unchanged, and the KBW was down about 1% here. So looking forward to this. I think this is going to be hopefully, some clarity, some outlooks from some of the CEOs, and get an idea of kind of maybe we get some helpful information in terms of where the Fed goes.
Yeah,
from here.
well, so that's what I want to hear is, as I mentioned, what these companies and what these banks, Carlette, say about, credit cards and how much cash consumers have. But I also want to know about wages and to what extent they're paying their employees more. And I'm not talking about, the investment bankers at these companies. I'm talking about the people who work on the ground in the banks. And if they're having to raise prices to attract and retain employees, if they're still doing labor hoarding, what that looks like, because that'll give us a good idea of the labor market and if it's changed significantly.
No, that's a really good point, although you'll have to get commentary on that, because if you just look at the numbers in the earnings statement, it's going to reflect all the pay for the investment bankers.
Exactly.
So you don't get a good picture of that.
And I don't get a question on the call
I'm a little
That's
confused.
the problem.
Why is Tim dissing the investment bankers? They are the salt of the earth for these.
When you look at the averages, we call those outliers, Roman.
On a serious note, though, I mean, how many people have we spoken to, economists, about the jobs data that basically says that while you are seeing tightness now in the market, people aren't necessarily laying off people or cutting things. They're just not hiring as much as they were, which is actually a good thing.
Right. Not laying off, labor hoarding, but for those who do get laid off, it's taking them a little bit longer to get a job on the other side. So, all right, guys, that's a wrap. Looking forward to what Friday may bring from Romaine and Scarlett.
Romaine's off tomorrow.
Oh, you are?
Romaine's going to meet with Macadamia nuts. Right?
Romaine.
Oh,
Zuck invited me out to his Hawaiian island there.
Oh,
man, you're just living the life.
It's a long flight, but enjoy.
All right.
Ellison.
Be careful.
Have fun.
Have
fun.
Don't eat too much.
Take some pictures, post on social media.
Let us know what the bunker really looks like.
I will.
All right. We will see you. Some of us will see you tomorrow. That's a wrap for our cross-platform radio, TV, YouTube, Bloomberg Originals. We'll see you guys tomorrow.
A lot more coming up here on the big program. Stick with us. We're going to look back here on the first day of trading for spot Bitcoin ETFs and look ahead to what might come next. Stick with us. This is The Close on Bloomberg. Relatively muted day here in U.S. equity markets, but of course all the talk was about the crypto sphere. We're going to get to that story in just a moment. Really recap the huge volumes and volatility that we saw in that space. As far as for Bitcoin itself here, still camped out around that 47,000 level, but honestly up 1% on the day really doesn't describe all of the ructions that we saw in between. We should point out that most of the crypto stocks themselves did end the day in the red, and we're going to get to some of the volumes and the pricing on some of those ETFs and those funds in just a second. Take a look at DocuSign, though. This was a story that broke just a little while ago here. A report by Reuters saying that Bain and Hellman and Friedman have apparently been in talks to buy the company. What was interesting, they also said that there were several other private equity firms that were also interested in this company, including names like Blackstone and a few others, some others companies that have already walked away. Those shares spiked about 10% on the day, and keep an eye on the banks. We do get a kickoff here of 4 of the 5 largest banks in the U.S. reporting before the bell tomorrow. Team Surveillance will have full coverage of that. As far as the broader market, not much to see here. Unchanged across the board for the S&P, the Dow, and the NASDAQ. The Russell 2000 did suffer a little bit more, down about 0.8% on the back of that inflation report. There's your 2-year yield. There's the dollar. That could change over the next 24 hours, given some of the positioning that has to take place for the end of the week. Another interesting story that I was keeping my eye on that kind of got buried amidst all of the frenzy surrounding Bitcoin here was the competition between Microsoft and Apple to be the world's most valuable company. At one point on the day, Microsoft did surpass Apple in market cap for the first time going back to November of 2021. Alas, so it did not actually end that way. The market cap on Apple did end the day right around $2.9 billion. Microsoft, just let me double check at $2.86 billion here. But again, this competition between the two, and we should point out too, Microsoft has been outperforming Apple by a significant margin over the last 2.5 weeks. Scarlett.
Yeah, the battle taking place in Silicon Valley. And of course, the Magnificent Seven as a group fell about 0.2% today. In the other direction, of course, we had Bitcoin ETFs. And of course, we've just wrapped up the first day of trading in the U.S. for those spot Bitcoin ETFs, which of course is seen by many as a landmark event for the roughly 1.7 trillion digital asset sector. So joining us now is one of the thought leaders in that industry, Bloomberg Intelligence analyst Eric Balchunas. Eric, we've never really had 11 ETFs in the same group begin trading all at once. Was there one particular winner? What's your takeaway here on the first day? Eric?
I think we're having some issues with Eric's audio here, Scarlett.
But we'll talk about that.
Oh, there he is.
There we go.
I made a rookie Zoom mistake. You'd think after all this
you'd think
time,
you would know this. Wow.
I know. No, what I was saying is that this was easily the biggest splash in ETF history. You have over $4 billion traded between the group. Now, GBTC isn't exactly a newborn, right? This is a trust that was converted. So even if we take GBTC out because it brought volume in, you're still looking at about $2.3 billion of the group. So this, obliterates a lot of the records that we've seen in ETFs. And IBIT alone, which is the BlackRock ETF, is probably the winner of the race, at least on day one, with over $1 billion traded. Fidelity number 2 at $670 million, followed by ARK, Bitwise. Franklin did pretty well, Wisdom Tree. You can see exactly in the first day what's probably going to happen long term. One big stud, a nice middle class, and then a couple that probably aren't going to make it.
Yeah, a couple that aren't going to make it. That's what we're watching for.
So what about just the broadening out of the offering? We were talking a little bit earlier, Eric, about the story on the Bloomberg terminal saying that there are some companies, including Vanguard and a few others, that are kind of in a wait-and-see mode as to whether they're actually going to allow their customers to actually access some of these exchange-traded products.
Yeah, I wouldn't sweat this. We knew that the platforms like Merrill and Wells Fargo, we call those the wirehouse platforms. You can't get on there, no matter who you are, at first. In fact, some of them, it's like pay-to-play, distribution, soft dollars, but they at least wait till you have a track record and assets. So forget about those. That's not weird. Vanguard, also not that weird. This is on brand for them. They don't let you trade leverage ETFs. They're a very wholesome type company. This is a philosophical decision by Vanguard. Not a surprise. Can tell it's irritating some people, but the late founder Jack Bogle, in an interview with me, said to avoid Bitcoin like the plague. Yeah. Not that it was personal against Bitcoin. He's just not into commodities. He likes stocks and bonds because the money works for you in terms of investment return and a coupon, whereas this is just worth what somebody will pay for it. So Bogle and Vanguard just generally not into commodities. Throw the fact that it's a digital asset. I could see Vanguard not having it on there, but just wait. They may get enough flack from their customers. They may add it down the road. We'll see.
Yeah, in time for sure. Bloomberg intelligence analyst Eric Balchunas, thank you so much for giving us the rundown here on day one for the spot Bitcoin ETFs. Let's continue this conversation now and bring in Peter Eberle. He is president and CIO of Castle Funds. Peter, what kinds of conversations are you having with clients who may want to add or perhaps even increase exposure to crypto and specifically to Bitcoin? Are they putting money into these spot Bitcoin ETFs, or are they waiting to see how things shake out?
So a lot of our investors are actually accredited investors that got in before the ETFs launched. And this was pretty well telegraphed after the SEC lost the GBTC court case a while back, that the ETFs were going to come. And so you've seen this big run up in Bitcoin over the past year, obviously 91%, over the past month up over 12%, and even just this week up 5%. So a lot of people got into position beforehand, and certainly the ETFs make it easier to trade in things like your retirement account and in your straight brokerage account. So that's a good thing.
That is a good thing. And you mentioned the court case that really forced Gensler's hand. Clearly, that's his stance. He made a number of disclosures. We did not approve or endorse Bitcoin. Investors should be cautious of crypto. The action doesn't imply approval of crypto exchanges. To what extent does that mitigate interest or enthusiasm for these products for a certain sector of the investing public?
Well, I think you hit on it just a moment ago, mentioning some of the brokerages that are not offering it yet. And that gives them a reason to hold back and wait to see how this new area works out as an asset class. So you have some hesitancy from some of the, as your other guest referred to it, the wirehouses, of letting their investors buy these ETFs. You have other brokerages that make their clients sign disclosures that this is a riskier asset. So there's certainly some of that because of the comments that Gensler put out yesterday during the approval process.
I am curious, I mean, if you could kind of look a little bit more long-term, Peter, here, as to sort of what this industry ends up looking like down the road. We've been talking a lot today about the potential adoption of crypto assets amongst a lot of just sort of, I guess, ordinary folks, let's just call them, basically the folks who maybe weren't crypto faithful or just saw inherently a level of complexity and risk to that, that in theory, the ETFs would maybe, I guess, cover for by providing at least greasing the wheels a little bit more. Does this mean we could see much broader adoption, or are we just going to kind of get this flurry of interest over the next few weeks and months, and then that's it?
No, I think there is. It opens it up to a whole new portion of the investment community, right? I mean, this is not unlike the gold ETF, where people didn't want to store gold bars in safety deposit boxes or at home or wherever, right? And so they can buy the gold ETF. The same way here, that people that aren't comfortable with self-custodying Bitcoin on a ledger device or another type of wallet, this allows them to get exposure to Bitcoin without having to deal with some of the nuances and the technology around Bitcoin. So I think there's two different types of investors, those that want to passively participate in it as an asset class, and then those people that are more into the technology side and this idea of self-custodying Bitcoin.
Absolutely, and there will always be those people for the retail set, and particularly for a lot of the advisors out there, investment advisors who are, if not push this to their customers, certainly definitely field interest from them there. There's been a lot of discussion about kind of reading in between the lines of what Gary Gensler said in his statement, and more importantly what that SEC filing showed, which was that technically there still is not direct oversight of this industry right now, at least not by the SEC.
Correct. I mean, we take the position that it's actually a commodity, right? And so the CFTC is our regulator, Castle Funds regulator, and both Bitcoin and Ethereum have been trading on the CME, the Chicago Mercantile Exchange, for several years now. And so that's where it's regulated. It's not regulated as a security. Now, these ETFs are securities, and they fall under the purview of the SEC.
Peter Eberle, really appreciate your joining us today. Peter Eberle joining us from California. He's the president and CIO of Castle Funds. Coming up on the close, we had Hertz reverse course on its push into electric vehicles. No longer betting big on them. We're going to have the details next. This is The Close on Bloomberg.
All right, let's talk about Hertz. The car rental company is planning on selling off about 20,000 of its electric vehicles and reinvest in gas-powered cars. This is a big about face after, well, just a couple of years ago when it said it was going to buy 100,000 Teslas as more customers were looking to rent EVs. David Welch joining us now from our Detroit bureau. And David, there's been a trend line over the last few months where we've seen, I guess, a slowdown in growth in the EV space in terms of people buying those cars. What was the issue in the rental market that made Hertz change course?
Similar thing. People weren't renting them as much as Hertz thought they would either, for the same reasons. There's range anxiety. People don't want to be on a vacation or a business trip, not sure where they're going to charge up, not sure about the reliability of the charging network out there. And Hertz said, while they did have them out there, they weren't, the utilization rates, as they call them in the rental industry, weren't quite as good as they were for internal combustion vehicles. And they weren't getting as much at the rental counter for them either. They were having to discount them. And then the costs were higher. Because Tesla cut prices so deeply last year, 25–30% for its models, that reduced the value of the vehicles in the Hertz fleet. So that is effectively a cost for the company, and the repair costs were much higher because there's not a very mature supply chain of replacement parts for these EVs. Mm-hmm. So you're looking at lower rental rates, higher costs. Yeah. It just wasn't a profitable venture, so they're dumping some of the fleet.
Give us a sense here as to how important the rental fleet market is or was for not just for Tesla, but for the other automakers that were producing EVs.
The EV market so far has relied on retail consumers. Last year, 1.2 million EVs sold in the U.S., and you're looking at 60,000 cars in Hertz's fleet right now that are Teslas, and that's the lion's share of their EV fleet. So at the moment it's not huge, but look at what Hertz's intent was: 100,000 Tesla cars, 175,000 from GM, 65,000 from Polestar. That is what car companies have always relied on when retail demand slows, to kind of sop up some of the excess production that they have. And that's not going to be there now because Hertz is going to pull back. Avis isn't going to pile in now because they see what Hertz did, and neither would National. So, and maybe corporate fleet owners won't either. We've also, the value of these fleets, of these cars going down isn't attractive for a fleet owner because they would want to resell the vehicle at some point, and they're going to take a bath on it until values of the cars bounce back. So this is a deterrent for other fleet operators to do it, and the companies are going to have to do it the hard way and sell at retail through their dealerships to get the EV growth that they're all looking for.
All right, David Welch, thank you so much joining us from Detroit. I mean, Romain, can you blame anyone? No one wants to spend their vacation driving around looking for a charging station and then charging their vehicle.
Well, of course not. And no one wants to. And I fell into that trap once on a vacation. And Richard pointed out, but you go back to the hype. I was going back at that time when they signed Tom Brady for this, and he's doing the to the moon tweets and everything. I have no idea how Tom Brady's going to get around now if he can't, drive a Tesla. But it gets to the question of whether they kind of overhype this. Why not just roll this out quietly, see what the consumer demand is, and then if it was there, you scale.
It's all about the hype these days. Romain's not about the hype. All right, coming up, we're going to talk about the latest survey of CEOs with Teneo, find out what the hype is there. This is The Close on Bloomberg.
A relatively unchanged day for U.S. equities, with the Dow, the S&P, and the NASDAQ only moving fractionally higher or lower, depending on which index you pick here. There's a lot of talk right now about that so-called last mile when it comes to the fight against inflation. We got a CPI report here in the U.S., and it really didn't clear anything up. While you did see a reacceleration in some of those key components, like shelter, like insurance, like used cars here, it wasn't meaningful enough to really change the narrative. Nevertheless, it also didn't add to that trend line of disinflation that a lot of people really wanted to see, and that caused a much more outsized reaction in the bond market. You saw the 10-year yield move lower by about 5 basis points, the 2-year by about 9 basis points, and now that becomes the backdrop here as we head into an earnings season that really kicks off tomorrow morning with the big banks. Banks that usually, Scarlett, are pretty candid about their outlook for economic conditions and, more importantly, their outlook for interest rates.
Yeah, and of course, we will bring you those numbers as soon as they cross tomorrow morning before the opening bell. In the meantime, we want to get a sense of what company CEOs and professional investors are expecting. Teneo coming out with a new survey of just that. And some highlights include the majority saying economic conditions will worsen. More than 3/4 are investing in AI. More than 2/3 expect M&A activity to increase. And 92% say they will stay the course on ESG efforts. Maybe they won't be calling it ESG, but on those efforts nonetheless. Joining us now is Paul Keary. He is co-founder and CEO of Teneo. Paul, nice to see you.
Nice to see you.
What were you most surprised by in this survey?
It's interesting. As a firm, Teneo, we have about 1,700 colleagues around the world. And because we're involved in big restructuring mandates, big reputational issues, big business strategy issues, we get the privileged seat in boardrooms and CEO offices around the world. And we also combine that with a discussion with institutional investors and CEOs over the last, at the closing months and weeks of 2023. And through that process, we got a sense as to what's the big concerns over 2024. As you touched upon, M&A is one of the few factors that institutional investors and CEOs align on, which is going to be a blockbuster year this year, across regions. And across the industries, but I think some of the industries that have focused, that have materialized even over since the start of the year include life sciences, technology, particularly AI-focused technology investing, and energy consolidation.
Okay, so more deal making, and we're already seeing that even though the environment is not necessarily forgiving. Borrowing costs are still pretty high, or they're going to stay at current levels, and Lina Khan is still at the FTC. She's not going anywhere, at least for now. So is the driver behind deal making generally more to defend market share or to take market share?
It is both. There is defensive and offensive strategies in mind here across the board. It was a relatively panaceic solution presented years ago, but now it is about, I think, both offensive and defensive. And I think the regulatory constraints that you speak of, the capital constraints, are factored into this, but the reality is that there is a lot of growth opportunities in the market and around the world.
Are they still worried about some of the economic conditions that have dominated the discussion over the last few years, primarily with inflation and interest rates?
I think the reality is that AI is driving a lot of requirement for investing. Energy consolidation is a factor and a reality. And I think there is an increased appetite, as you've seen in the life sciences industry, for shareholder accretive actions, including on the spin-offs in front. I think what is really interesting is that divergence of view between investors and the CEOs that they invest behind. Both have a very different view as to 2024 in terms of the economic conditions. Last year, on our survey from the previous year, you could argue investors got it right. They were bullish about 2023. They're bullish about 2024. It's, I think, easier to understand that in many ways because the last year of an election cycle, in the US particularly, always delivered strong returns in the equity markets. But if you're a CEO, Romain, you're challenged with geopolitical issues, political issues, a really uncertain economic environment.
Well, let's talk about that too, because it's not just an election here in the U.S. I mean, I think the stat that everybody's talking about is something like 40+% of the world's population is going to go to the polls at some point this year, including in some very prominent nations, including the U.S. And then we have an election, I think, this weekend in Taiwan. I know that in the short term, these elections don't always move the needle, but obviously there are long-term policy consequences that can come back and affect corporate fundamentals.
Yeah, the reality is, as you mentioned, half the planet go to the polls this year across multiple markets and multiple regions. And in our survey, the number one issue identified as the major disruptive factor for CEOs to address this year is political disruption. And that means trying to factor in what's the likely industrial policy changes. What could the regulatory or legislative shifts bring? And what would geopolitical trends get impacted by changed administrations across the world? So for the first time in our survey, it has been political disruption has been identified by CEOs across the world as a consequence. It's been the number one issue that they have to factor in, both in terms of the opportunities and the challenges that it presents.
And so there's been some political disruption when it comes to things like ESG. You have 92% of CEOs saying the course on that, which is surprising because it diverges so much with the narrative that ESG is this political hot potato that is more trouble than it's worth at the moment. Are they simply just tweaking the language, going with responsible, accountable, sustainable, and continuing to do what they've been doing these last few years?
Yeah, ESG is interesting. As you say, vast majority are staying the course on ESG. However, if you dig into the detail, about a third of CEOs are reconsidering, however, and reevaluating their DE&I policies. As a consequence, not surprisingly, due to the broad-based pressure that CEOs have to face on a whole range of issues. So I think the response is going to be about companies leaning in on the issues that matter most to them and their stakeholders. I think listening more rather than being forced into a position of pronouncing an opinion on all matters. So I think there's going to be a lot of opportunity for companies to do what's right on ESG without being running for office.
But I am curious. You made a good turn of phrase there, because how much pressure is on these CEOs to make a statement? I mean, we saw that during, of course, the George Floyd incident here in the United States. We've seen that recently with the situation in Gaza and Israel, where there's been so much public pressure, and for that matter, internal pressure by employees for their CEOs to come out and make a definitive statement. And if you don't do that, at least as we've seen with university presidents, you can lose your job.
Yeah, I think the CEO class in particular has always shown themselves at the forefront of doing what's right for all stakeholders. And embracing ESG, I think, is going to be a key fundamental of that mandate moving forward. I think, however, CEOs are not running for office. We don't want them to run for office, and they shouldn't be expected to have an opinion on all matters. What you will see is an increasing lean-in, and the survey supports this, on companies really doubling down on the issues that matter to their stakeholders, to their consumers, and finding a path to make sure that they add value across those communities where appropriate.
Right, looking for areas that have direct impact on what they do. You're going to Davos this weekend, where the big thinkers, the big policymakers will be gathering. What do you expect to be the theme coming out of Davos?
I think it's interesting. I think coming into Davos is perhaps a good harbinger, and you mentioned earnings season really starts in earnest tomorrow. I think across the board, CEOs have been reflectively cautious on the macroeconomic environment for this year, despite the bullishness of investors. I think most CEOs are controlling what they can control, focusing on what I call operational alpha, and weighting a more supportive macro environment for growth strategies. So I think that's the sentiment entering into Davos. As always, Davos does deliver some new, I think, perspectives. Be interesting to see next week whether that level of caution and that level of concern over 24 gets accelerated, or whether it gets dampened over the course of those discussions.
All right. Well, we wish you well on that trip. I'm sure you'll be in hot demand here by all of the big CEOs and other thinkers there out at Davos. Paul Keary is the co-founder and CEO over at Teneo. All right. You just mentioned it. Bank earnings, the earnings season officially kicking off tomorrow. Wells Fargo, Citigroup, Bank of America, JP Morgan, just some of the names set to report tomorrow morning. Dick Beauvais, Chief Financial Strategist at Odeon Capital, going to be joining us in just a bit for a preview. This is Bloomberg.
Earnings season begins tomorrow morning with Bank of America, Wells Fargo, JP Morgan, and Citi all kicking it off before the opening bell. Here to help us take a closer look is Bloomberg U.S. Finance team leader Sally Bakewell before things really start to heat up. Sally, let's focus in on Citi because it's kind of become the darling bank stock of late with a couple of notable upgrades. Jane Fraser, of course, has started this big restructuring effort. How many quarters is she going to need to really spread out the cost to reorganize this organization?
Right. So what they really want to do is sort of complete this restructuring by the end of this quarter, the first quarter of this year. Now, we just learned yesterday, interestingly, that this restructuring, this big overhaul, which is its biggest, in decades, it's going to take about a $780 million charge tied to that restructuring. So that has now been telegraphed to the market, so they know that going into earnings tomorrow morning. So it'll be interesting to see how shareholders react. So they'll also be looking for further indications of the charges or the costs of this restructuring, in particular job cuts, because we know that there could be potentially thousands of job cuts associated with this restructuring, and those all are planned for the first quarter. There is no number yet tied to them, but we have a well-known analysts like Mike Mayo estimating that it could be something like 25,000, and this bank is a bank of about 240,000. Although he his number also includes the jobs lost from Citi's other sort of big action, which is its retail exit. It's exiting from all of its retail operations around the globe.
Yeah, Citi's definitely in the spotlight given some of those changes. Let's talk about two of the more boring banks out there, Bank of America and JP Morgan. Let's start off with JP Morgan, because I feel like every quarter they end up being kind of the winner, if you will, for bank earnings. I mean, it's been a steady ship there. Are you expecting any surprises tomorrow?
Right. They have had a pretty good year. They benefited a lot from the turmoil because they are sort of seen as this too big to fail bank. They saw a lot of depositors who were spooked by the regional banking turmoil flee to them. They also, of course, benefited from purchasing First Republic, which gave them access to a lot of that bank's clients. They've made a big push into the void created by Silicon Valley Bank when that collapsed too. The bank, JP Morgan, is expected to post another record for net interest income, which is, you know, the biggest revenue source for banks. And overall, most of the banks are likely to post a decline in profits because, you know, interest rates have continued to be a drag, raising the cost that they need to pay depositors, muting loan growth as well. But JP Morgan actually, interestingly, probably will still post an increase in profits. So it's going to be a good quarter for them.
It somehow always does, right? Let's talk a little briefly about Bank of America and contrast that with Wells Fargo, which is limited in how much it's able to grow its assets. It continues to be held back by the Fed.
Right. So Bank of America, it has, you know, facing a slew of charges actually, potentially upwards of $5 billion that it has already announced. Again, it's telegraphed those to the market. They're associated with, all the banks are paying charges related to the FDIC's Deposit Insurance Fund, which was depleted to protect uninsured depositors at the time of the regional banking turmoil. But Bank of America is facing other LIBOR charges, ESG charges as well.
Yeah.
It is also the bank that had the biggest pile of unrealized losses owing to its investments in longer dated securities. So that's been painful in the sense that it was an opportunity cost for the bank. So it will be interesting to see what the Chief Executive Brian Moynihan says about that sort of pile of unrealized losses. They always say they have plenty of liquidity and they're not in any sort of concerning position with it.
All right, Sally Bakewell will be spearheading our coverage tomorrow morning when those big bank earnings start to roll out. Let's keep the conversation going and bring Dick Beauvais into this conversation, Chief Financial Strategist over at Odeon Capital, who's been covering these companies for years, decades, really. And Dick, I want to start off first with kind of separating the wheat from the chaff. We know the fourth quarter is always kind of weird for these banks because there's a lot of sort of one-time charges and other things that I think kind of obscures just how well or how poorly, for that matter, they're actually performing here. What do we need to look at as just sort of a one-off, and what do we look at that gives us a better picture of the longer-term trajectory of the earnings picture?
Well, I think it should be understood that the banking industry in the United States is doing extremely well financially. There's no particular financial risk, but it is in great trouble. It's in great trouble because it's losing market share relative to other parts of the financial industry virtually every year, and not losing by a small amount, but a large amount. In other words, if you compare bank deposits to the money supply, or if you compare bank loans to capital market activity, if you compare, their activity in the private equity markets to, if you will, banking companies, you'll see that the banks just lose relative to everyone else. So the question is, and the question I think has to be answered tomorrow, is which way are you going to go as a bank? In other words, my view is that, 5 years from now, and maybe this is an extreme statement, I think 5 years from now, banks will be taking in deposits, making loans to the U.S. government, and paying dividends, and they will have lost most of the other businesses that they operate at the present time because they just can't compete. Therefore, I think the banks that are most interesting at the moment are the ones who know that, who recognize that. And as was just described, Citigroup is clearly one of the banks that recognizes it and recognizes that this change is coming. So it has jettisoned businesses which are likely to show very little growth because the banks will lose market share further. And they're moving into businesses where they can dominate and where they can grow very rapidly. Bank of America, on the other hand, has spent its time perfecting the old way of doing business, and therefore the outlook for Bank of America is far less attractive.
How easy, or let me rephrase that, how hard will it be for some of those companies like a Bank of America to pivot? And I say that against the backdrop, too, without speculating too much, that there could be a leadership change there at some point in the near future.
Well, yeah, the CEO of Bank of America is 64 years old, and while everybody talks about who's going to replace Jamie Dimon, I don't think Jamie Dimon is going anywhere. But Brian Moynihan is a different story. There is a very good chance that there'll be someone replacing him. Not next year, but in a year or two. So the net effect is the question is, who will they pick, to bring the bank through the next, if you will, 5 years, decade, whatever you want to call it. Because if they pick someone who is going to continue to focus on the consumer, the growth in deposits, the ability of the consumer to borrow money or to invest in securities, asset management, they'll pick the wrong guy. They got to pick someone who is involved with the old Merrill Lynch, someone who is involved with capital activity, capital management activity, capital goods, someone who is really strong in business processing, that is the movement of funds from one place to the other. If they pick someone like that, then Bank of America's outlook, I think, will be somewhat better.
You had mentioned that Citigroup understands that the pie is getting smaller overall for big banks, whereas Bank of America is moving in the opposite direction. What about at JP Morgan?
JP Morgan seems to recognize that this is happening. In other words, some of the statements made by Jamie Dimon indicates that he knows that this change is underway. He is well aware of the fact that the banking industry is losing market share, and he is, thinking about making use of his bank holding company structure, to a greater degree. I mean, if you go all the way back to 1970, when Walter Wriston, the head of Citibank, created Citicorp, which was a bank holding company, the whole concept was, let's get away from relying solely on banking, and let's get involved in other parts of the financial industry, money management, money movement, et cetera. And the banks have done that. What we're finding is that they've got to accelerate that move at the present time. I think Jamie Dimon sees it because he has said that he understands it. Whether JP Morgan will change dramatically, which is what I think they need to do, or not, is about to be seen. But quite frankly, I think that bank understands where this world is going, and I think that bank is going to be attuned to how it should operate in that new environment.
Okay, so you're talking about long-term structural change here of the banking industry losing market share to non-bank finance companies over a number of years. In the meantime, everyone's obsessed, everyone within the banking industry certainly is obsessed with the Basel III capital rules and how they're going to have to change and adapt to that. Is that kind of a red herring at this point, a distraction from what really needs to be addressed?
No, that's at the core of what I'm talking about. In other words, essentially, when these banks went under last March, what the United States government recognized was that A, it had to tell people that it was guaranteeing every dollar in every bank in the country, and B, that was impossible. It couldn't be done. So the solution, from the standpoint of the government, was to come up with this 1,087-page report in which they're curtailing the risk that the banks could be to the United States government. And they're curtailing it by creating a series of rules which make it very difficult for banks to operate in businesses that they've operated in before. So, it's very much part and parcel of where this situation is going, because the U.S. government simply cannot take the risk that, $19 trillion in deposits represents to the U.S. taxpayer, and they're not going to. And they're not going to, because they're going to keep forcing the banks to get to shrink smaller and smaller, which is why I say, when we get to 5 years from now, they'll be lending money to the United States government, paying big dividends, and they won't be representing a huge risk to the U.S. government.
Some big sea changes coming for the U.S. banking industry then. Dick, thank you so much for joining us. Dick Bove of Odeon Capital, getting us set up for the bank earnings season that begins tomorrow morning. Now, still ahead, that, of course, is on the agenda. But what else do investors need to watch for tomorrow? This is The Close.
All right, a busy day here. Let's look ahead over the next 24 hours of what the market is going to have their eye on. And we're going to start off in the second largest economy in the world.
Yeah, we're talking about China data. It'll be CPI, PPI, also trade, exports, imports. But it really feels like China is less and less a critical part of investors' portfolio these days.
It's interesting, too. I mean, I wonder if that's sort of at their own detriment, right? I mean, it's easy to ignore them now, but at some point, you have to reckon with not only the second largest economy, but it's so intertwined with so much out there. Let's go back to the U.S. here, because we are going to get another read on inflation, this time from the producer side.
Yeah, wholesale inflation coming out, and of course, after today's CPI report, which showed that prices continue to rise at the end of 2023, perhaps surprising people who thought that disinflation movement would continue.
You know why I'm smiling?
Why?
Because we get more Fed speak tomorrow. We haven't had Fed speak in a while. Whatever happened to all the Fed speak?
Kashkari, of course, the Minneapolis Fed president, will be speaking at 10 a.m. right when the market opens.
It's like an extended holiday vacation for these folks. All right, we do actually get, though, to the meter earnings season. This is what really moves the market. Of course, we've been talking about the big banks, but we also get non-bank companies, including Delta Airlines, as well as United Health.
Oh, yeah. I thought you were going to talk about BlackRock. Not a bank per se, but an asset manager. BNY Mellon, Custodian Bank, will also be reporting. As Dick Beauvais and Sally Bakewell were telling us, a lot of these banks have already come out with their big charges, so that prepared investors for what they might expect.
Always interesting to hear their commentary, particularly on economic conditions. I'm certainly will hear that from Jamie Dimon. Whether the others want to be as candid remains to be seen. We're actually going to have an interview with the CFO of Wells Fargo tomorrow.
Yeah, we're looking forward to that. That'll be at 2:10 p.m. during the close.
All right, stick with us and be sure to tune in tomorrow early. Team Surveillance will have full coverage of all those bank earnings. Meanwhile, Balance of Power is up next.